yield. And that's going to be a big reversal when rates start rising in Japan.
If and when they blink, they restructure, and the jump condition here, I'll leave it up to you, but let's model, Lisa, $140 yen, and we get a much stronger yen, and let's say we get down to 120, 115, dare I say, we get back to what we used to perceive as normal. We get a strong yen. What's the ramifications to China basically flat on its global GDP back?
Well, China, it's almost become its own animal there. I do think that the strong yen will impact all the regional exporters, right? The weak yen has really been squeezing the competitiveness of not only China, but also Korea and Taiwan. Those crosses are at multi-year, sometimes multi-decade lows in terms of the yen. And if and when that changes, we have not only the capital flow story, but we also have the trade flow story. That is, Japan exports are likely to become less competitive. China may become more of a factor, but the reason I couch that with some caution is that China has turned so much increasingly inward in President Xi's third term. It's really hard to figure out how China fits into the global story. I do think that we're overestimating its impact on sort of global growth and trade right now. It's really turning inward. It's trying to boost domestic consumption. And you can see that in the regional trade numbers. Exports across the region are still diving double digits. And so, again, I think we spoke this last time I was on, that I think the world has to really rejigger and really try and figure out how to move forward with a very different Chinese model.
Wayne, one thing that you said was you look at dollar yen in part to get a signal for the dollar, and the signal right now is that the dollar is going to get stronger. How much of a pain trade is that?
Well, yeah, I'd say dollar yen has been the biggest pain trade. I think at the beginning of the year, folks were calling for 120, 125 yen. I imagine some still are. But that was really predicated on the notion that the Bank of Japan was close to pivoting, removing accommodation, and Governor Ueda has turned to be as dovish, if not more dovish, than his predecessor, Kuroda. And I think that was the game changer for dollar yen. Yeah, sure, they can surprise us. They love to surprise the markets, and we could eventually get a surprise in liftoff yield curve control elimination sometime in the second half of this year. But it seems to be later rather than sooner. The data out of Japan are turning. We're seeing some weakness in the hard data there, and I think policymakers really there are really shy about pulling the trigger on a regime change in policy.
On a broader level, though, I'm wondering, when does this sort of signify a broader dollar rally that isn't exactly what people are positioned for at a time when they've gone into emerging markets, where they've gone into the euro on the promise of both more rate hikes from the ECB as well as a stronger economy on the heels of whatever stimulus China is continuing to double down on? Do you buy into that is going to be the theme of the second half of this year, the reversal of perhaps a bit of dollar weakness in the first half, going back to dollar strength?
Yeah, no, Lisa, that's a great point. I think that was the other sort of consensus trade. The dollar's going to weaken. Fed was going to stop hiking and cut rates actually this year. And that's also been a bit of a pain trade. It had ups and downs. Obviously, the banking sector crisis kind of derailed the Fed tightening expectations, and we had the debt ceiling. But I think when all this dust settles, I think the Fed is going to go higher for longer. The market still doesn't quite believe the Fed. They've got one hike priced in, but the Fed has signaled there'll be two. And I sense that there are a lot of analysts that don't think the Fed will hike again. That is, this isn't just a pause. This is the end. I wholeheartedly disagree. I think the U.S. economy, to your point, you guys were talking earlier about how the resilience of the housing market, I'll throw in the labor market, consumption, et cetera. The U.S. economy remains solid, I would say strong, dare I say. And I think the Fed has to go much higher and much longer than I think the market's expecting. So yes, tying it all together, that to me tells me there's a stronger dollar in the works, stronger than what I think the markets expected when we started the year. Negative for EM, global liquidity is tightening still. Not just the Fed. ECB hiked last week. This week we've got the BOE, Swiss National Bank, Norges Bank, all hiking rates. And that's all, to me, very negative for global liquidity, global growth. I think the dollar still stands sort of head and shoulders above everyone else.
But this is the point, when you go right where I want to go, and this is maybe outside your remit, but I'm going to go there. You say the dollar stands head and shoulders above all else. I got completely wrong, for example, the equity return in Korea. Asia flat on its back, COVID and all, and up goes the equity stock market. How can you have international stocks do well with a resilient, win-thin dollar? I don't get that. It doesn't compute.
Yeah, no, I'm with you, Tom. And again, it's not just a resilient dollar, but also global growth is slowing. There's no question about it. The OECD and IMF, World Bank are all warning of much slower than expected growth in H2. You know, maybe we get a recovery in 2024. You know, there's the whole equity market, you know, saw that, oh, well, markets are forward looking.
Right.
Are they looking ahead to 2024? It's hard for me to say, but I share your puzzlement, Tom. It's hard for me to see how emerging markets and global equities have done so well.
We got to go, but I got to get this in because you brought it up. Do you buy the IMF gloom? Do you buy the IMF 3-year global slowdown?
You know, I think, you know, we can all sort of talk about how right and how wrong the IMF has been, but I think in this time, they're right to be err on the side of caution. You know, again, the U.S. is doing its part to hold up global growth, but eventually it's gonna go into recession. I fear that. When is anyone's guess? But that's just another piece of the sort of the slower growth puzzle. China's disappointing. Japan's turning. We've already got two straight quarters of contraction in Eurozone. UK is going to go into recession. It's hard not to be gloomy. You know, again, but this is a run-of-the-mill sort of business cycle recession. It's not a pandemic. It's not a great financial crisis. So, you know, if you want to look beyond that,
right.
Yeah, okay, we'll get through this and we'll be okay.
Okay, very valuable. Winston, thank you so much. Dr. Thin is with Brown Brothers Harriman with a great focus on foreign exchange as well. Well, that was like on the edge of Bramwell. That was, you know, he's cautious.
A lot of people are cautious. It's just that AI and everything is AI. So then what do you do with that?
As Bramwell mentioned earlier, the market craters today. The SPX down 0.4%, 16 points. Dow down 120 points as well. Stay with us on Bloomberg Radio and television, Bloomberg Surveillance.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. From the world of politics,
we're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that
it.
Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience would get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this
Is
story.
there the kind of upside?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
really feel the markets are kind of getting divorced from the Fed?
The issue really is the lagged effects of policy.
I think that the Fed is going to have to continue to raise rates or stay higher for longer. The market is not pricing that in.
There are extremely few historical examples of the Fed hiking, pausing, and then resuming hiking.
I think the Fed has to sleep with one eye open well into the future because the economy has changed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Bloomberg Surveillance, Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Thank you for being with us amid a 4-day work week. John Farrow on assignment, having, we hope, a restful time. Is he in the northern or southern hemisphere?
I don't know. I have to check his assignment calendar.
Check with his entourage.
We'll see what happens.
He actually takes some people with him just to be sure that, he gets on and all that. What an interesting Tuesday, and the conversations so far have been interesting. If you missed our last hour, Win Thin, I thought, was riveting on Japan and particularly on dollar resiliency. He just doesn't buy the gift of a weak dollar.
Yeah.
That's all there is to it.
And this would be one of the various pain trades that could potentially emerge in the second half that people are talking about, especially with the euro, given that it has started to break out.
Well, Ben Laidler getting us going here with some resiliency on this bull market. And coming up, this is going to be must listen, must watch. Sebastian Page with the definitive book on, what do you do in allocation? What do you do with your money? How do you diversify? We're going to do that here in a moment for Global Wall Street. For the rest of you as well, really can't say enough about that this morning. I look at the churn of the news off a clumsy 3-day weekend and into an even clumsier 4-day weekend. And basically, and I make jokes about this, folks, but unfortunately, when Lisa does her brief, the Fed speak, it beginneth.
To me, the biggest theme.
Well,
it's important, especially ahead of the all-important meeting of Jay Powell on Capitol Hill tomorrow and Thursday. It feels like there's a collision course, and I keep going back to this. The reason why people are bullish right now is because they don't believe the Fed's going to raise rates twice more, if at all. And this, to me, is sort of one of the underpinnings at a time when people expect inflation to go lower and for there to be some sort of immaculate disinflation, although no one wants to say this. If the Fed goes twice more, can the AI rally continue? And a lot of people are saying, tougher to see that.
Every 6 weeks, June 14 out to July 26 sort of captures a 6-week cadence. And I'll go there, and I guess the July meeting's important. But the next meetings are July 26 to September 20, which seems like wider, seems like forever.
Can I tell you this story that caught my eye? So Dan and Yogurt, they came out and they were talking about how they're an AI company because they're using AR, artificial intelligence, to study the gut bacteria in order to craft something that's better yogurt. Here's my question, right? So is everything an AI company? Is everything, if you basically say, we're going to use computer programming, we're going to use neural nets to try to understand our inner guts, then you're an AI company. At what point have we gotten perhaps past the peak?
I think I got to admit, I'm very happy you brought this up. You know what camp I'm in. The whole thing is ridiculous. There will be winners. There will be people that will move forward. I guess NVIDIA is a winner. I don't own it. But the basic idea is, yes, in every vogue, there's some validity. But at the same time, clearly John Lawler from Ford Motor told us Ford's an AI company. Bloomberg's doing Bloomberg GPT or whatever. I get it, but yeah, I think we've reached the silly season.
Well, yogurt, I don't think of as being particularly artificial intelligence. Just to give you a sense of what did get the most in terms of trades, investors poured more money into Tesla last week than any other stock, and the other most popular contracts are NVIDIA, AMD, Apple, Meta. And those are, of course, the top AI trades. Tom,
I don't think they're doing AI trades right now, but I'm looking at Spotify, which if you have Offspring, they have Spotify. There's no question about that. And finally, I think this has been hugely anticipated within the music business. Spotify competing with Apple Music, with Tidal, and the rest, says they're going to have a premium tier, and it's going to have some form of hi-fi audio. They've been way behind on this. And we forget, here's something that essentially society uses each and every day with a return back 5 years. 5 years 2.4% per year. I mean, it just hasn't worked out. There's no other way to put it.
Yeah, you're going to expect more of this. Right now, perhaps that's not enough to really drive everything higher. You are seeing stocks a bit lower as we do head and potentially a breather, although pairing some of those losses because you can't keep a good market down.
Don't start with the Fed speakers. Brief us on something more constructive than the Fed speakers.
8:30 a.m. U.S. building permits, U.S. housing starts for May, and the Philly Fed non-manufacturing activity. Also, I do say that FedEx, after the bell in terms of earnings, may also be an economic bellwether.
Yes, I strongly agree with this. I was not aware of that. That's why Bramo kills it. With the brief. We have FedEx after the bell.
That's correct.
Folks, it's as big as Apple's earnings. That's all you got to know.
Definitely a broad bellwether, also a bellwether. Fed speakers today include St. Louis Fed President Jim Bullard, who has been speaking in Barcelona, and at 11:45 a.m., Fed Vice Chair for Supervision Michael Barr and New York Fed President John Williams. And then, of course, later in the day, we do have German Chancellor Olaf Scholz hosting Chinese Premier Li Qiang in Berlin. At the same time that 4 lawmakers in the U.S. head to Detroit to talk to GM and Ford about perhaps shifting supply chains out of China. So definitely differing messages from the diplomats versus some of the rank and file in Congress.
Moments ago, HSBC, the Hong Kong and Shanghai Banking Corporation, cuts their China GDP now this year to 5.3% from a more optimistic 6.3%. Not a small moment there, as we heard from Dr. Thin and Brown Brothers Harriman moments ago. Sometimes I miss it. And very often there can be a book of the summer or the book of the year, and it just, for whatever reason, in the Tom Keene blur, I blow it. I blew it with Sebastian Page's phenomenal Beyond Diversification. I'm going to give him the highest regard on this. This is the most important adult Wall Street book since Richard Bernstein's classic volume on value and growth. I can't say enough about it. Every time I look at it, I'm blown away by the acuity. Joining us this morning, the author of Beyond Diversification, Sebastian Page. The shingle is out at T. Rowe Price. Sebastian, I'm going to get right to it. You talk about quack remedies. What's the quackness of asset allocation in 2023?
Tom, we're going through a regime shift in asset allocation. You know, this is a critical time in capital markets history, in my mind. After 40 years of declining rates, we've finally made a higher high in rates, and we've wiped out $17 trillion in negative yielding debt. This begs the question, what do we do with asset allocation? Both tactically, how we navigate this regime shift, and that's been very confusing, but also structurally, the 60-40, you often ask that question on your show. I think the 60-40 needs to be modernized. I think of the 40, we should add maybe 15 to 20% in different alternatives and look for equity protection strategies. And so rethink diversification. This is a critical time for doing this, Tom.
This is really important, and folks, this is with the Sharpe ratio, with the risk-free rate finally back to normal, and the Sebastian Page religion is, you know what, folks, that was a nice 15-year gift. We're back to normal. We can't go out and find private equity. We're not Blackstone, we're not KKR, et cetera, Sebastian Page. How do our listeners and viewers participate in the Sebastian Page 50, 15, whatever the rest is, an alternative?
You know, liquid alternatives are interesting if you know how to select them. It really matters how you define liquid alternatives, but investment strategies that focus on relative value, that have less of the traditional market exposure, are also available in liquid forms. But it also calls for rethinking how you navigate markets tactically, how you protect for the downside. In a nutshell, Tom, the big question for the 60-40 is, what is the role of duration or treasuries when we get interest rate shocks? Now, to be clear, we just had a 500 basis points shock from the Fed. We're not getting another one. In fact, we've been adding duration back into our portfolios. But it's a critical question. If you look out 5, 10 years, what is going to be the volatility of interest rates? What is going to be the volatility of inflation? And how do you position your portfolio for those types of regimes? And this calls for things like hedged equity strategies. It calls for things like real asset equity strategies, you know, stocks that we kind of didn't really like for the last 10 years pre-pandemic, right, when inflation was below 2%, but energy companies, real estate investment trusts, metals and mining, precious metals, and so on, strategies that have a levered response to inflation shocks. This is all part of the new regime for the next 5 to 10 years.
Well, how much is this regime changing in real time? There was a time, perhaps, I don't know, 5 months ago when people thought that tech stocks were the most interest rate sensitive, and yet we've seen yields rise and tech rally in tandem. Is that connection also broken? Is that diversification in these two areas perhaps different than it was just 5 months ago?
Yeah, look, in the short run, say, think 6 to 12 months, we're navigating treacherous waters. I think the narrative around growth stocks has been driven by different factors. Lisa, yes, this correlation seems to have broken a little bit, but there's also an underlying narrative of, yeah, okay, we're pretty close to peak rates. Those big tech companies have shown that they're focused on efficiency. And then, of course, you know, you see positive surprises on cloud revenues, positive surprises on digital advertising, and then you hit sort of another kind of regime shift in AI. And that's really been part of the story. And you've covered it at length in your show. But, you know, AI's been around for a long time. It just seems like the large language models and the ChatGPT are kind of yet another regime shift we're going through. And that's all part of the value versus growth equation. Lisa, we went back to neutral in our portfolios. We were long value all of last year, and we benefited from that. Now we're basically back to neutral between growth and value. We don't want to be underweight if the AI bubble, quote unquote, if you will, is kind of like 1998, right? So we'd rather be at neutral right now.
Sebastian Page, thank you so much for joining us today with T. Rowe Price there. I can't say enough, particularly for pros, about beyond diversification. Hugely thought-provoking as well. West Texas Intermediate 72.09. If you're looking at the energy sector that Mr. Page was just talking about as well, 10-year yield 3.77%. The 2-year yield 4.70%. Standard & Poor's 500 up a negative 0.32%.
If you're just joining the program, we're taking a look at S&P futures that are 0.3% lower. And I do wonder, Tom, if we're looking at something that is the beginning, or to Sebastian Page's point, there is this issue of, you know, even if there is a promise, is there going to be a pause here? And how do you play that at a new time of perhaps interest rate expectations?
My problem with 60-40 spin, and he mentions Markowitz and all there in the book, I'm hearing people, Abby Joseph Cohen was talking about this as well. There's this alternative investment space, which is fine. It's a pro space, but I'm not sure how that gets into someone's 401k. I mean, if you get 13 choices in your 401k, we all know what they are. There's like money market fund, I'm almost scared bonds, bond portfolio got slaughtered last year, blue chip equity, growthy equity, foreign equity, and a bunch of marketing concepts. Where's alternative fit into that?
I will say, when I tried to get barrels of oil in my living room, it was very challenging to get real assets, and then to have the infrastructure around it, the ventilation, you know, dealing with children coming in. I mean, there are a lot of potential challenges to real assets that, you know, perhaps are not as you know, recognized by people saying go into alternatives. I
mean, to me, and this is the shock, and we actually dealt with it last week a little bit with the shock of the Fed meeting, and it's it's the idea that the game we're comfortable with for 15 years, it's done.
Maybe.
It's
Some
done.
people argue against that, though. Some people say we're going back to it.
There is a group that looks for rapid disinflation. One of the great themes that's out there. Good morning to Ed Hyman, David Rosenberg, and others looking for yields to come down. We'll drive this conversation forward at 8 a.m. On the equity markets, Scott Cronert will join us, U.S. equity strategist at Citigroup. We're looking at the equity markets, Dow 34,000, SPX 4439.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
I raised U.S. concerns, shared by a growing number of countries, about the PRC's provocative actions in the Taiwan Strait, as well as in the South and East China Seas. On Taiwan, I reiterated the long-standing U.S. One China policy. That policy has not changed. We do not support Taiwan independence. We remain opposed to any unilateral changes to the status quo by either side. We continue to expect the peaceful resolution of cross-strait differences.
The Secretary of State on Taiwan, a little bit of a ferment about those comments. There's always, when you talk about Taiwan and your Secretary of State, it's like right from the start a lose-lose conversation. You're going to get something wrong on that. But the Secretary of State, after an historic, do you agree with me on that, an historic trip to China?
Breaking the tensions after some serious ratcheting up where people said it was the worst period ever in the relations between these two countries.
Terry Haynes giving us good perspective in the recent hour here. We do this with renminbi, and it's not the first thing I look at when I come in, but let's get direct. Rounded up 7.18%. on a weaker Chinese yuan. It has been a devaluation. This is really, really important, folks. Depreciation is where a currency is free and floating. Devaluation is where a government's really in charge of moving its currency around. And Lisa, critically, I don't know where China fits into that. It's so opaque. But I would use the word with China devaluation or sort of devaluation light, because they control the yuan to a huge extent.
Well, and perhaps they aren't necessarily getting involved as much as people really would like. That's one thing that kind of came up over the past couple of days is they're kind of trying to cut rates around the edges, but they're not delivering anything more major to really prompt some sort of more robust growth to come back in that economy.
We'll have to see on that. Right now, we get a brief on China. We do with Jeanette Lowe, Managing Director, Policy Research, Strategas. It is a Baird company. Jeanette, I love your note in that you don't mince any words. You say China is broken. That's such a outlandish phrase. What do you mean when you say, how do you mean China is broken?
Well, good morning. So we have been, obviously, investors have been thinking about whether or not there was going to be this big China rebound once it stopped its COVID-0 policy and started to reopen up. And we just really haven't seen that transpire. Instead, we do think that the Chinese economy is quite broken at this point, and they're struggling a little bit to try to figure out how to right the ship as they try to move forward. And we think that part plays a little bit into the talks with Blinken and the talks with U.S. business leaders as well.
So extrapolate that forward. I'm curious if you are seeing some sort of desperation on the part of China, or not that, but there's recognition of some of the declines. How can they give the assurances to businesses at a time when policy leaders are pushing them on the other side to de-risk, to move supply chains out, and frankly, that they aren't necessarily facing free trade in that nation?
Right. And so I think that China is actually trying to do that balance. So you have seen that there has been this issue with supply chains. You've seen increasing rhetoric come out of the United States where they are pushing companies to move out of China, to move to other locations, to reshore, to nearshore, to friendshore. And what we have actually seen is that companies have been moving out of China to some extent. We've seen production that is going to remain in China, obviously stay. But then if there is production that would actually move to other countries, they're starting to move those supply chains out. And we think China's actually been quite surprised by the rapidity at which that has happened. So they are now trying to do kind of a charm offensive. They're trying to make sure that they are still looking open for business. They're trying to meet with U.S. business leaders and try to convince them to stay in the country. But they also do recognize that there is this trend within the U.S., that the U.S. is also pushing this with the West to try to move supply chains out of China, de-risk or decouple, depending on what country you may be talking to. But there is definitely still a concerted effort, regardless of whatever conversations Blinken had with Xi over the weekend, that there is still going to be an effort in the United States to try to specific, areas of tech controls, things where we think that it's really important for the U.S. not to be supplying China anymore. That's going to continue to be a focus, and it's only going to continue to grow over the next couple of months. You've seen, as you've looked at what's been happening in Washington, on both the Republican side and the Democratic side, there continues to be a push to try to be tougher on China. And so that policy is not going to change anytime soon.
Jeanette, one reason why it's really great for us to be able to speak with you is because you talk with companies and you talk with different policymakers, and you can find the cross sections between the two. You said the charm offensive is to convince U.S. companies not to move their supply chains out of the nation as quickly as you say that they are. Is it working? Are they buying into the charm offensive of Chinese officials?
So I bet that there, to some extent, there is an effort to, I wouldn't necessarily say buy into it, but I think that, companies are trying to balance as well. They understand, I think, what is coming from the U.S. side. I think they have to figure out how do they still manage their operations in China and try to also make sure that there are guarantees as well, that if there's something were to pass, if there were to be even another COVID, for instance, how do you deal with supply chains shutting down again? That has been one of the biggest concerns that's actually driven production out of China. But companies need to also kind of be on the lookout, and I think that they are, by looking at supply chains, and they're seeing what is on the forefront of policymakers' minds in the U.S. and even in European countries. And they also have to play that balance of how quickly do we potentially move, what do we move, and then what do we think is going to be the next steps over the next couple of years, and where do we see that impacting their bottom line?
If you're just joining us, futures at -15 here on a Tuesday morning, the VIX 14.43. Jeanette Lowe of Strategas with us this morning. Jeanette, I want to turn to the domestic story. And what I notice here with the distraction of Blinken to China is there's really not much going on in Washington. I know I've got to be wrong on that. What are you focused on within our domestic debate as we begin summer in Washington?
So the U.S. has been focused on the debt ceiling for the past couple of months. Obviously, that was resolved at the beginning of the month. And so now we're starting to see policymakers turn to other things. One of the biggest things that you're hearing talk about is what are they going to do about the budget? Are Republicans going to try to cut the budget more than it was agreed to during the debt ceiling deal? That's going to be a big fight. They actually have quite a bit on their plate going into the second half. And so we do actually think they're going to be rather busy over the next couple of months, but particularly towards the end of the year, as is normal in Washington. But they're going to be focused on China legislation in particular. They're going to be focused on appropriations. They're going to be focused on defense. And then we do also think that there is this possibility that we could see a small fiscal stimulus bill towards the end of the year. You have the House Ways and Means Committee actually did a bill last week where they tried to talk about, increasing the standard deduction for taxpayers and also cutting taxes for businesses, restoring full expensing for the R&D tax credit, going back up to 100% expensing for businesses. And so there's talk also of trying to do some of these things as well. And we think that that could show up again at the end of the year.
Is that to extend the Trump tax cuts?
So it is somewhat aligned to that. So he's kind of set up the deadlines where it would fall into place when the Trump tax cuts do expire in 2025. But there is this effort also, in Washington to think about looking ahead to the election year next year. So they also want to think about how is the economy doing? We think a small stimulus package is more likely if you actually have the U.S. economy slowing going in towards the end of the year. Mm-hmm. And so that's where this could also play in factors, where they're trying to make sure that there's some stimulus to make sure the economy is in decent shape as we move into electoral politics.
Jeanette Lowe, thank you so much. Jeanette Lowe is with Strategas there on China and on our domestic policy. Did you see Greg Villiers this morning? He's been off. He's like Pharaoh. He took off like a 3-island tour somewhere. Villiers comes back, and his entire morning note with AGF, get it from AGF in Toronto, is on the deficit, on the interest buildup we have, higher interest rates, the amount of money we're paying for interest to the government. It's not, Villiers is never gloomy, but as Jeanette Lowe alludes to there, it's a really sporting 6 months forward in Washington.
Another way to put this is, remember when we thought that we would get some sort of fiscal discipline, and we talked about how the debt ceiling resolution seemed to try to enforce some sort of caps on spending. And here we hear Jeanette talking about an expansion in fiscal stimulus, right? So at what point is fiscal policy moving very much in the opposite direction of what people think it will be and continuing to support some of this ongoing prolific spending by American consumers?
I mean, the numbers are I've lost scope of the numbers. He's throwing around like 30 years out, it's a $50 trillion. I can't hug the numbers. I don't really know what to do with them.
I think it's a great observation. It's part of the reason why people don't really get a handle on what the deficit issues really are, because the numbers are just too big.
Of course, when you're in the triple leveraged all cash fund, you can't even hug the bull market as well. 44.38 on Standard & Poor's. Negative 15. This is Bloomberg. Stay with us.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Bloomberg Surveillance, good morning. Jonathan Farrow on assignment, Tom Keene and Lisa Abramowitz here trying to get a 4-day work week started. And it's just sort of a churn to the market. Lisa, do you have one statistic here that gets you excited?
Well, just simply where we've been, right? That we've had 8 straight weekly gains on the NASDAQ. That is the greatest rally, the longest rally going back to 2019. And we've erased all of the losses from 500 interest rate hikes that had been incurred on the equity markets. We have now erased that as we continue to chart forward. To me, those are some of the interesting aspects going forward as we perhaps take a bit of a breather this morning.
Let's frame that exactly. 4440 on SPX. I'm still not used to 4,400. There's some people above that, but not many. It's a pretty lonely crowd. Binky Chada may be leading the way. I believe he had 5,000 there at some point out 4, 5, 8 years. I'm kidding as well. Dow 34,500 on the Dow, negative 110 this morning. And NASDAQ of 15,000, not above 16,000. But, you know, as we sort of slide into Q3 and how many people have been wrong who have to readjust here, I really wonder the framework of a second leg, and I haven't used this phrase in ages, of FOMO, fear of missing out. Think of the size of the missing out of people that have been in the triple leveraged all cash fund.
I was trying to think this morning, is it FOMO versus the fear of hiking rates? What's the sort of bifurcation right now in markets, the fear of overheating that people are talking about? Taking a look at some of the specific names, frankly, is sometimes more interesting at a time like this where people kind of can't get their hands around what exactly is going on the macro front. Nike shares lower by almost 2%. This comes after Morgan Stanley raised concern about inventory problems, saying it could weigh on margins in the fourth quarter. And this comes after Nike has crushed it. The direct-to-consumer trend has absolutely given them this incredible boost, and yet difficult to understand the inventory picture and the shifting winds in the post-pandemic retail economy.
Before we get to stocks with Lisa, and there's some really interesting stories today, this is the where in God's name is John Farrow moment in the show. We'll be doing this every day as he is on assignment, and it's Pirelli. Like, I enjoyed so much watching the Montreal Grand Prix this week, and I really blame John for this. I've really gotten into watching it, and I won't bore you with the details of why it was so interesting, but Pirelli makes the tires, like all the tires of the Grand Prix. They have one company that makes them. The Pirelli CEO designate, Giorgio Bruno, is said to leave company. And basically, this is where the Italian government has stepped in and said to China, you can't own Pirelli. I'm saying this very loosely and very uninformed. I want to be careful of this. Tommaso Ebhart and Danielle Lepedo are a lot better at this than I am. But this is an interesting China story involving Europe, where Sinochem is involved. Sinochem International. I'm going to read this verbatim. The succession plan was part of a proposed shareholder pact between China's Sinochem, the company's largest shareholder, and Camfin Holding, but it's going to be radically modified by the Italian government. I find that fascinating. I don't know what to make of it, but there it is as a side story, if you will, on a Tuesday. What is the other stocks you see, Lisa?
I'm also looking away from the Italian domestic stories. I'm also looking at Philip Morris because this has been one area that has been really underplayed and people basically moving away from it due to some of the concerns about ESG. And some people now saying, including Citigroup, that perhaps it's undervalued, raising it to a buy from a neutral. Those shares up 1.4%. Alibaba, interesting, because we're seeing it sag 2.3% after they replaced their 8-year veteran chief executive, Daniel Zhang, then basically replaced him at the same time that people are concerned about a lack of stimulus announced by China that they're expecting. Chinese stocks and the ADRs are down just more broadly today.
I look at Philip Morris, PM as a symbol. It's very confusing. There's Philip Morris, there's Altria. And the 10-year total return, we're so used to in times past, where MO was an Apple-like blue chip certitude stock. No, 5.5% per year on Philip Morris for the last 10 years. So it's been different. This is not Altria, this is PM, the more international operation. Right now, speaking of international, Ian Steely joins us, CIO, Global Fixed Income, Currency, and Commodities, off the London desk at JP Morgan, and joins us in our New York studio. Thank you so much for being with us.
Thanks for having me.
I love, it's like it's a Haley Mills movie coming out. Remember The Parent Trap? There's the cash trap. You are blistering in your note about the cash trap. How grim, how wrong is it to be in cash right now?
I think you've got to think about what happens. So cash looks great today, but will cash look good in 6 months' time, in 9 months' time? If we are having the slowing environment that we're seeing economically, if the central banks do need to do a bit of an about turn, then ultimately buying fixed income assets, buying core bonds at 4 or 5%, they give you that attractive yield, maybe not quite as much as cash, but then you get that capital gain over the course of the year if we do see a movement lower in yield. So there's a real benefit of having that. And then, of course, what we've seen really since Silicon Valley Bank is that right-way correlation has returned. And the good news is that bonds can become that diversifier in your portfolio. When we do have times of stress, we've seen over the last few months that bonds perform like they should perform. Unfortunately, like they didn't last year, but they are going to do it going forward.
Are clients growing disenchanted with cash, or is the cash trap incredibly attractive partly because it is a yielding asset?
I think actually clients at the moment, the clients that I speak to like cash because they are a little bit confused about what's happening in the bond market. We've obviously seen these big gyrations throughout the course of this year, and then they're looking at risk asset valuations, and you were talking about it, the fear of missing out. Equity markets where they are today, credit spreads, particularly in say high yield credit where they are today, actually it's just safer to be in cash. But I still think that on a 12-month, on a 24-month forward-looking basis, bonds is probably going to deliver you a better return than cash.
Can you get bonds rallying and stocks rallying at the same time? And this has sort of been the real concern for a lot of people, that if you do get some sort of downturn, that's going to be a real problem for equities at a time when a lot of people are expecting that actually will act as a stimulant going forward for equity risk tolerance.
It feels difficult. I mean, that's sort of the perfect scenario. It definitely can happen, but there's a very fine line for it to occur because you would need to have that soft landing. You would need to have the central banks turn course at exactly the right time when they don't stifle growth too much and they just allow that sort of runway, that smooth runway to happen. That feels a bit of a challenge when you look at what the central banks have been highlighting over the last few weeks or so, is that they want to keep going. They want to effectively nail down this inflation problem. And the only way that I can really see the central banks being able to have that smooth runway would be inflation coming down off its own accord to the levels that they would like it to be. And that does feel like a challenge at the minute.
My read of the weekend, Gideon Rockman, the FT, short, sweet, and I knew the U.S. had bested Europe in nominal GDP over the last 10 years, but Gideon absolutely nailed how Europe is falling behind. A lot of people in America are curious about the ownership of European blue chips. You guys own this space. Should we be in European blue chips, or is there just truly an American exceptionalism?
So if you look at the composition of Europe, yes, it's definitely not as supported for the tech markets. Now, I'm going to say from a bondholder standpoint, obviously have maybe my equity cap on, but if you look at the returns that we've seen more recently, Europe is starting to take a leg higher. It's starting to improve. And I think the underperformance of Europe that we've seen for a long period of time is starting to come back. We're starting to get real rates in Europe, starting to get a lot more confidence around Europe. So I think actually there is some benefits to investing in Europe. But of course, I say I've got my bond hat on.
No, but you get your bond hat on. But this is really important, folks. One of the things is a different dividend strategy and dividend growth in Europe as well. Are those generally higher dividends in Europe, a bond equivalent?
They are more of a bond proxy. We don't have that effectively tech element in the European markets. The yields that you're getting on the European space within stocks is attractive. Likewise, for the first time in a number of years, in a couple of decades, really, I can say the yields you're getting on European fixed income are attractive again. They are compelling. We're no longer at that zero or negative lower bound.
I have to say, at this midpoint in this year, I have to just reflect on the fact that people are gaming out 4% ECB rates at a time when people thought they could never get above zero, right? And we aren't necessarily seeing the fallout that people thought that there would be. Same thing in the U.S. As we take a look into the second half of this year after a 500 basis point move by the Fed, can we say that the expectations were wrong, that some sort of rapid increase in rate hikes would cause some sort of credit crisis, some sort of massive unwind of the years of zero or negative rates?
So I think it's difficult to say that hasn't happened yet. That still could well happen. But no, definitely, you're completely correct. We've seen definitely a more buoyant economic environment. We've seen consumers healthier than we had expected, able to deal with high rates. Now, you could argue that a lot of it is the pent-up demand that we've still got on the back of the pandemic. You could argue that we've had this huge amount of stimulus from the government side that has supported it. We've had payment checks being sent to people. We've had furlough schemes in place over in Europe. I do think that over the coming quarters, we are going to start to see that pain coming through. If you look at some of the comments out of the Resolution Foundation in the UK, only around a third, I believe, they believe, or at least the Bank of England is saying only about a third of the hikes is fed into the broader economy. We've got a huge amount of mortgage refinancing to occur. I mean, these high rates are going to start to impact. They're just happening with lags, and possibly, maybe I think the issue that people had was that those lags are taking longer to play out than people were expecting.
Maybe off your remit, but I'm going to go there because it's not a fixed rate, it's a floating rate. The floating rate structure of real estate in Europe, and particularly the United Kingdom, what's going to be the damage to the floating rate structure versus a much more fixed rate America?
So the good news for the UK is that the floating rate structure is not as bad as it used to be. We've had a number of people term out mortgages into 2 years, into 5 years. So it does push out, again, it pushes out that day of reckoning. So those lagged impacts take longer to come through. But we are starting to see the people that were taking in mortgages back in 2021, they're likely to come. I think it's about a third of mortgage refinancing in the UK happens over the next year or so. So we are likely to see it. Definitely can't argue with it. The US is in a better place with its 15-year and 30-year mortgages, where they were able to fix at 2.5%, 3% a couple of years ago and don't have to worry about it.
Lisa and I would like Ian to come back again when John's here, because then we'd be surrounded by British accents. I understand about every 4 words.
I understand everything. That was
I
fabulous.
understand Ian better than John.
Ian Steele,
I understand Ian Steele. Sometimes John, I have no idea.
What are you talking about? John is completely
It's like
clear.
Ted Lasso. When John starts talking, when he really gets going, it's like Ted Lasso. There's like every 5th word I can't understand. Ian's like poetry,
Yeah, I'm going to send him a clip of this.
Send him a clip of that. Yeah. Ian Steele, thank you so much. With J.P. Morgan off the London desk in New York today. Futures at -14, Dow futures -116, yields elevated. Stay with us. S&P, the percent, -0.3%.
Tom, one thing that I was reading about is the submersible, the submarine that is missing or at least off the grid, looking for the Titanic wreckage, and has a crew of 5. I'm just wondering what you make of this, considering the fact that it is not something that we want to relive with this, basically one of the worst crashes out there. People going down to see it, and then potentially getting stuck.
Everyone of a certain ilk, of a certain generation, is always and forever scarred by the Thresher. It was a submarine of the United States Navy that just simply went down, and it was back with technology. It was a lot less than that, and it was just a frightening time for kids, very much in the zeitgeist for weeks and weeks and weeks, and America was humbled by that technological failure of the U.S. Navy and of our submarine fleet. And of course, it had so much to do with the modernization of our fleet. My only observation is all of us pray for these 5 people and the huge search, and a search at huge risk in a brutal North Atlantic. They've said it's brutal. Is that it appears that this submarine, to call it that, submersible, had very, very non-sophisticated technologies involved. And that will all come out, I'm sure, in the coming weeks.
Yeah, racing to find them in the 96 hours, I believe, that they have of oxygen, emergency
It's
oxygen.
brutal.
Yeah, we are all thinking of them, and definitely something that caught us all kind of in this horrible memory.
It is, and the Coast Guard out of Boston on that search will continue to follow that for Bloomberg, particularly out of London and New York. Futures at -14, Dow futures -108. Stay with us. This is Bloomberg Surveillance.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. And the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000 to put in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
It's moved from people taking deposits away because they're concerned about the health and safety of those banks, much more just people, okay, where can I earn 5%, 4%? What am I going to do with this money? So I think there's going to be this slow bleed. Banks are going to be forced to issue more debt. I think they're going to be forced to extend their balance sheet. So maybe they're preparing for that. So it's not overly concerning.
Peter Scheer, Academy Securities, head of macro strategy. So sorry I missed him on Thursday. He's always great, isn't he?
He's always
great. It's a great summary there of what's going on.
Talk about how we don't really care about the Fed anymore that much, or basically that's not sucking the oxygen out of the room. You'd appreciate that.
Well, yeah, and I think there's still ramifications coming on here. I made light of it earlier, but folks, seriously, I think the Fed speakers have some validity this time around after the absolute shock of that Fed meeting, which we're still within. I think we're still within the shock of the meeting of the 16th. It's, what's today, the 20th? Are we already up to the 20th?
The pause was confusing, and there's a lot of explaining to do by not only Fed Chair Jay Powell, but also some of the officials. We'll be speaking later today, as well as into the rest of the week.
Dot up high, Mr. Bullard will speak as well. We'll see how he reaffirms the 2 rate increases that are expected as well. We're going to rip up the script here. We can do this with a guy extremely supple in the financial system of the world, and that is Bloomberg's Jan Patrick Barnett. He's in Frankfurt, and of course, one thing to talk about is UBS and Credit Suisse and the mating and what it's going to cost. And the other is, as reported in the Financial Times this morning and with Bloomberg's reporting as well, that Abu Dhabi at least had meetings, cups of coffee, and no doubt good Zurich coffee, with Lazard. Jan Patrick, I want to rip up the script, and we can do this with you. And it's as simple as boutique firms, always with a European basis. They're out of Paris like Rothschild or Lazard, or they're out of Zurich. You know the names better than I do. But they are coveted by outsiders, including petrodollars. How pervasive is that tone in John Patrick Barnett's Europe?
Well, I mean, like the landscape here in banking and in general is different to the US, right? We have like the major European banks here who are all caught up in this de-risking that we have seen over the last 12 years, and then you have kind of a sideshow, so to speak, that has evolved in Europe over the couple of years with all those boutique firms that you mentioned, who are run by individuals, by people who are keen to take on more risk than the big banks can do, and that's something that we have seen in Europe for a while now, and I'm pretty sure it's going to continue because what we have seen now in the Eden of Mars, so to speak, with UBS and Credit Suisse and all the saga going down, and the ECB just yesterday saying they will put on harsher stress tests on the big banks. The risk appetite for those major banks in Europe, I don't see that going up. I see that rather staying the same or even going down. So there will probably be more for those boutique firms in the more risky parts of the business to grab market share there.
They're going to grab market share, but are they going to do it? And this is a delicate question, and I'm just simply looking for what Bloomberg reports with our great European banking team. But are they going to do it with majority foreign ownership, like maybe English football, Or is it going to be just understood to be minority ownership? How will that cut, including what we saw with Credit Suisse with different tranches of minority Arab ownership?
Well, that's a good question, and I mean, like going forward, the question to me is like, if you want to really like put a stake up there in a European bank, what are the lessons learned from the Credit Suisse story? And the lessons learned from my perspective is that you can't be sure anymore that you're being treated at the best outcome when the push comes to shove, right? So, is there anybody out there like super keen build majority stakes in European financials? I'm not so sure. Of course, there are like lenders who are in a good position, who have a good business model, who have a, let's say, halfway decent balance sheet that can handle some storm at least. And can you build there an interesting stake for dividends and for share gains? For sure. But I think you can do that with minority stakes. You don't need to be a major shareholder here in any shape or form.
Yeah, and Patrick, you are at the epicenter of one of the biggest banking stories of the past decade, which is the Credit Suisse firm becoming part of UBS. And we're hearing some of the reasons why perhaps UBS wanted that backstop from European governments, from the Swiss government in particular. How much are the liabilities of Credit Suisse making it difficult for there to be really the standalone entity that some people think, and that even UBS has said they want to keep?
Well, that's the very big question mark and the elephant in the room, and that's why the purchase price on paper was so cheap for UBS, where they just paid a couple of billions for an entity that was worth 15 billions not that far ago, because nobody really knows like what else is there underneath in the books, how those assets are going to perform in the next couple of weeks. Litigation is a big issue, and we see this today again. You can always like estimate this so far, what the regulator and other the courts, the judges will put on you. And let's not forget, UBS has a fair part of that on its own, on its balance sheet. So that's something that they figure out now, and that they have to figure out fast, because as I always said, like investors don't like uncertainty. And the benefit of the doubt for UBS, it's a complex merger, and we have to give them some time to figure out all the details and all the stuff. But I guess that the litigation is something that they're going to address rather fast. Because you don't want to have those headlines. They're never good, right, in any way. So you want to settle with the regulator here really fast and make sure that the amount is bearable, which I guess is in line with the story that we have seen today. And then you have at least one topic off the rails, and you can focus on the train going forward and what and focusing on the technical things of the merger and how to integrate clients and customers and all that stuff.
How is morale right now at the remaining Credit Suisse unit at a time when Sergio Armati talked about the need for a prudent corporate culture and emphasizing that and basically saying there are going to be pretty significant job cuts at the unit at Credit Suisse in an op-ed that he published over the past couple of days?
Yeah, I really want to know that, like in a broader scale. I speak to a couple of people, and what they are telling me is not like super enthusiastic. I mean, they know what's coming at them, and that is going to be a difficult few months going forward with the merger. And it's very interesting that we saw the chairman and the CEO both being very harsh in terms of what they're saying towards the employees. And that tells me again that their message right now is for the investors. They want to tell the investors that there will be no hiccups going forward. There will be no more of the same misjudgment of risk, misjudgment of balance sheet, that they want to reassure investors that this merger is going to be profitable for them at the end of the line. And for the moment, they don't really care about the morale. Of course, they need the people on board to going forward to make this merger work in the long term. But for the time being, I feel the main priority is like keep the investors on board,
right.
Make sure the share price recovers, and then we can talk about like the people who are left over and what to do with them.
Yeah, Patrick, one final question. It's a question that I would ask of Sonali Basak, our chief financial correspondent. It's June, and I understand you take 4 weeks off in August, as does everyone else in Europe. But what is the rationalization of headcount going to look like among European banks into the fall and even into early next year? Is there a foreboding to that?
Well, I mean, like the headcount of European banks has never gone up over the past decade. There are good reasons for that, and I don't see that changing. That said, most banks, especially the major ones, they have cut headcount so far that I'm not really see like if they can cut like more here. AI is the big thing in the room. I mean, like, let's see if this frenzy is entering the financial area as well, and if they can cut even more, if they use more technology. But the big thing is going to be Credit Suisse. I mean, the company had employed like 50,000 employees, 17,000 in the investment bank. And what he said, he wants to do massive cuts. And when a CEO says massive, he usually means like 50% or more, is my guess. So we will see 10,000s of jobs being lost here again, mainly from Credit Suisse. But it's also a topic still for the other European banks. Nobody's like really hiring on a big scale here.
Yeah, I'm Patrick Barnett. Thank you so much. Great brief there in European banking. Love that. From Frankfurt with all of his skill in journalism and banking as well. I'm absolutely fascinated how this works out. I mean, I mentioned this last week. I can't remember on radio or TV, but Lisa, I'm just so colored by my childhood and understanding of 3 Swiss banks, and I'm in shock that there's only one Swiss bank. I think whatever they say about whatever they're going to massage with Credit Suisse.
That is, I think, a shock that a lot of people are feeling, especially at a time where Sergio Armati in this op-ed said the combined Bank of Switzerland, because this is now the Bank of Switzerland at a time when competitors are being rolled up into one.
We'll have to see. Right now, in the data check, futures at -12, Dow futures -109, the VIX 14.36. Again, we're watching Bitcoin here just under 27,000. An eventful 10 days with Binance and Coinbase and Bitcoin. In the yield space, yields were higher. Now they're lower, swinging around here. We've got some economic data coming out in 30 minutes. Remember, it's a Tuesday, not a Monday, so we do have economic data today. On the housing market, oil 71.68 on American oil, the dollar fractionally weaker. On radio, on television, this is Bloomberg. Good morning.
From the world of politics,
we're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience would get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes, or yes. Not keeping, look, people have conviction or they invest for if they invest for the right reasons, just keep at it.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
there's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
I'm very concerned that we are going to see a hard landing.
There's nothing to suggest that the labor market is about to collapse.
There's no sense that there is a wage price spiral brewing right now.
If people start to think inflation is more sticky, then you are going to have more issues with wages.
I wouldn't be surprised that what we have is really a sluggish economy without necessarily having a deep recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Is FOMO running out of steam? And this is Bloomberg Surveillance on Bloomberg Television and Bloomberg Radio. Tom Keene, Jonathan Farrow, Lisa Abramowitz, shot us off on vacation, which is a wonderful thing. And I ask this, Tom, is FOMO running out of steam at a time when we are seeing a slight decline in equities, but just a slight feeling, perhaps, in some of the analyst notes, that we can't avoid a reset after the run-up that we've seen?
Going day by day. As you mentioned, it's been 8 weeks of up and a little bit of a pause today, but and we're going to have another equity strategist on in a moment. Everybody's got a different view, but I would look at the marginal shift, and maybe it's a shift over time of where you go higher in your SPX estimate and the when of it. So you say, okay, we're going higher, but it's a year-end 2023 higher, or it's a mid-year or year-end 2024 higher. So there's a number of moving parts to what people are doing besides resilient bears out there that are just saying, no, this is all wrong.
You know, you raise a good point, and this is something we heard from Mike Wilson as well in the past couple of weeks, where he basically said, you know, we do see declines, but then they'll revive into next year, into the year after, when you start to see some of that dynamism. So then what's to say if forward-looking instruments are stocks? Why not look past the pain, get to whatever happens, then we never get to that sort of downturn?
Ian Steele, I thought, was very valuable in from London, joining us moments ago with JP Morgan, and you know, he called it the cash trap. I make a joke about it, but I'm sorry. If you're in cash, you're not in the game if and when you move higher. And that's a 12/31/22 lesson. There's no question about that into this mid-year 2023, which is coming up in 10 days. But to me, the major thing here is, how do you recalibrate if you've been wicked right? How do you recalibrate if you've participated in the market? Yeah, sort of, kind of like, how do you recalibrate if you've missed this? That to me is fascinating.
It's a tough year. My question is just going to be, is FedEx going to be an AI company when they report earnings after the bell? Are they going to say that they're using AI to dramatically transform their technology and suddenly their shares will pop 400%? I mean, at this point, are we looking at something where there is this reality underpinning some of the hopes and dreams, but perhaps people are getting a little bit frenzied and carried away and they'll sort of thirst for some sort of return?
Stay with our Bloomberg coverage on this 4 p.m. into 5 p.m. hour. Romaine driving that conversation forward. And it's real simple. FedEx is a really important bellwether for what's going on and what we're going to see from corporations. And as you know, we've heard from others, and Stuart Kaiser mentioning it here, the revenue growth guess is the major thing. Bears like Mike Wilson just say the revenue growth's not going to be there, period.
Well, how do we get down to a lower inflationary environment if you don't see some pain? And that's sort of one of the key questions underpinning a market that has seen 8 straight gains on the NASDAQ, which is the longest streak of wins going back to a 10-week streak in 2019. Today, the losses are not that significant, clawing back just a touch. S&P futures lower by 0.3%, 44.41, not exactly a cry in terms of pain. I mean, we've retraced all of the losses since the pandemic. So not only since the pandemic, but since the Fed started raising rates by 500 basis points, Tom.
Yeah, I didn't get a broadening out. I mean, that was the phrase over the weekend. I think a lot of people published over the longer weekend here in New York City, and there's no question about it. broadening out is the phrase du jour, and we'll see if that continues.
I'm watching yields. I'm watching the creep higher. A little bit of a breather today on 2-year yields, going down to 4.7%, just a touch. Yeah, but they had been at the highest levels since before we saw some of the banking concerns. And the euro gaining just a touch versus the dollar. We've seen that pretty consistently, especially given the ECB projections for more rate hikes.
2-10 spread, 95 basis points. It's just really, really quite wide and really speaks to the tension. As I said earlier, Fed speakers today may really have some value. James Bullard of St. Louis. Can we just assume he's the highest dot plot? I mean, is he the, I don't know what McKee would say to that. Is he the outlier dot?
Could be. I think there are a number of people who are on the same page with him. And let's see.
In the equity space, we've really focused on this morning because we've listened to you on radio and television, and you want to know equity opinion around equities, bonds, currencies, commodities. Mr. Cronert is equity strategist and managing director at Citigroup. We're thrilled he could join us this morning. Scott Cronert, what a strange time. I want you to describe right now how you address in writing fear of missing out. Where is that in an equity strategy right now?
Well, where it is right now is in the performance gains you've seen in this tech growth component of large cap equities. And it's also increasingly showing up in a lot of our positioning data. So over the weekend, our quant colleagues pointed out that looking at futures positioning, it's about as bullish as you've seen since the global financial crisis. So there certainly has been a crowding in effect underway as this NASDAQ-led rally has really kicked in.
My head is spinning because I'll see on a given day, the bet is negative, the bet is caution, the bet is woe is me, we're all going to die, the bull market's going to end. And then you just said the bet is actually that people are very bullish. You can't have it both ways. Which is it?
Well, the starting point is the fear that was kicking in last year as the Fed peak hawkishness was kicking in, and we were really concerned about recession risk. And so you went into this year with probably a little bit more concerned positioning related to this mega cap growth cohort, which felt the impact of the multiple compression last year. Heck, we're using this 4,000 target that we can get to. The same target we used start of the year. Start of the year, we looked bullish versus the futures implied positioning. Mid-year, we're hanging on to this target. Now we're looking bearish. So, there has been a pretty good seesaw at work here. And I think the point we're making is that what comes with this price action is an implicit expectation around fundamental follow-through. And our concern, quite simply, is in the shorter term, for all of the AI euphoria kicking in, the higher you go now, the higher the implicit expectations you set up for, and that just sets a pretty high bar going into the Q2 reporting period.
So you think that this is going to be an earnings-led decline because we're going to see some sort of decline to get down to your target of 4,000 before going up to where you see it eventually ending up, which is around where we are right now. So is that really going to be the catalyst? Big tech earnings reports that disappoint?
I think we're going to find across the board, every company in the country better have an AI strategy that they're talking about as you go into Q2 reporting period. The issue is going to be to what degree does that show up in fundamentals? And it wasn't that long ago that we were thinking AI was sort of a 25 event. It's been pulled forward, courtesy of some of the big tech names of late. I just think that what we're going to run into is this disconnect with how hard the market is run versus where earnings expectations are. We started the year 213 for 2023 earnings. We're up to 215 now. And so our call around earnings resilience has been very solid here. It's just a question of to what degree a lot of expectations are being priced in perhaps too quickly.
So you think that people who think the Fed is going to be the killer of this rally are overstating things, that there's going to be some sort of additional rate hike or two, and perhaps stickier inflation that could really undermine some of the valuations that have gotten baked in here. Do you dismiss that?
I think that's a part of the equation, right? So we're kind of coming at it more fundamentally based, but to your point, Lisa, you're still looking at a Fed that is going to need to see a little bit stronger deceleration in inflation metrics to feel comfortable changing tune. Again, here, Citi, the House view is another 1 or 2 hikes. And we're looking at a Fed funds futures curve that is quickly right-sized over the past couple of months and is now pretty comfortable. You're looking at a 5% Fed funds level into the end of the year. So every step we go in terms of nudging up targets for the S&P, you still have to compare that to the return on cash. It's a pretty interesting trade-off that investors are facing right now in this. But there's no doubt in our mind that a higher for longer Fed, higher than expected versus 2 months ago, the interest rate backdrop, all of this plays into an interest rate tailwind that does keep somewhat of a lid on where valuations can go.
Where's the lid on valuations 3 years out, 5 years out? I'm not talking about buy and hold, Scott Kreiner, but you've been doing this long enough to know the percentage of money that's in the game for the financial media is long term, like 36 months. How do you scope 36 months given all the angst that's out there?
So it's not easy to do, Tom, clearly. So the way we've kind of come at it, heck, a year or so ago, we were saying, hey, geopolitical risk premium is going to knock a couple multiple turns off the S&P. Now we're looking at this disconnect with how you're going to value growth versus cyclicals and defensives within the market. The way we're thinking about it is that what's happening under the surface, and this is going to be a direct AI and an indirect AI influence, the opportunity for productivity improvement across the S&P 500 and broader equity economic landscape here in the U.S., we think is going to get really interesting here. So longer term, we're pretty comfortable the market can hold a higher valuation, courtesy of mega cap growth and tech, but also because the rest of the market is going to prove out that it's less cyclical than historically perceived. And I think AI, in addition to other forms of technology that have aided and embedded productivity improvements, end up underscoring a higher valuation than many investors have gotten comfortable with. So from our view, this is all timing. We think we've run pretty hard. We need to digest the move. But the setup here as we navigate this recession risk in the second half of this year is higher for longer coming out the other side.
Scott Kreiner, thank you so much for the brief with Citigroup this morning. I think our team did a great job over the weekend, just lining up a set of equity people, all with different nuances.
Timing.
I mean, we don't have an Arch Bear in this morning. Maybe we'll solve that in the coming days, but I'm fascinated by it. Dow futures at negative 111, the VIX 14.36, off an S&P 4442. The S&P on a percentage basis, a negative 0.3%.
Yeah, if you're just joining now, we are seeing a bit of declines on a day where we're perhaps reconsidering the gains that we have seen over the past 8 weeks. Right now, I am curious about where the bears are. Is there anyone who's willing to come on and say that they're still seeing some sort of imminent crash the way that they were, say, 5 months ago?
No,
I have not heard
crash. I'm not hearing crash. I mean, that's a Bramo talk. And the fact is we're not hearing crash talk. And maybe we should have a radar up because of that. But certainly there's a bear structure of a leveling, and I'm going to call it within a broad sense, 200 points from 4,400 down to 4,200, or dare I say 4,000. And then beneath that is really based off earnings. And what we heard from Scott Kreiner in the writing from Citigroup is their bet is away from that towards an earning resiliency.
Well, and that's the difference. And people are expecting, even if there's a sort of soft patch, it's going to be a year-over-year comp issue, and that they're going to sort of see earnings gains in 2024. Yeah. I keep going back to this. Then what is to hold people back from saying, okay, it's a long-term, forward-looking instrument. We're going to look past whatever softness is in the near term and look to what happens after that. I mean, how much are you hearing that kind of tone from a lot of investors
I think it is people, look at the bear market shock last year, down 13%, down 17%. In some cases, a price down, yield up, and barely able to articulate that. In a bull market, we get the bounce off the bottom. Maybe it's a dead cat bounce. That's what the gloom crew would say. But then the answer is you form a belief that gives you the price always out ahead of the belief of a second leg up. And that's the bet right now. There's no question about that. Our bet is foreign exchange matters. Dollar slightly weaker. Euro over 109, 109.33. This is Bloomberg.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special Equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Right now, there's a herd mentality of ordering just to protect future slots.
We've always tried to be conservative in terms of net output, not to overproduce to the market. We know that is bad for pricing.
They already have substantial orders in the order book of both Airbus and Boeing. The problem is that even if you order today, you're not going to see those airplanes for the next 5 years.
Among others, the leadership of Qatar Airlines just saying, oops, I guess we better order airlines. It is that time of year. The guy just becomes more happy. He's usually very Bramo gloomy, and he lives to go to the Paris Air Show. Have you ever been?
I have not been. Have you been?
I would love to go. I just like to hang. I just like to walk around Guy and his entourage and see Guy Johnson do Air Guy like he does.
I was reading one story talking about how there's a bubble in airplanes and just the incredible rush into just ordering as much as you possibly can.
Like a post-COVID thing.
Which to me, it's sort of, it really creates a really interesting environment given how massive they are, what the floor must be like.
We know to all of our audiences, airlines matter. That's why Bloomberg Surveillance has done so much on here over the years with a wonderful Bloomberg Airlines team, our aeronautical team, I should say, in transportation. No one's focused more on this than Guy Johnson. He's been committed to a study of the aviation business since time began. It is Boeing, it is Airbus. Who's winning the race now, Guy? What's a partial score of Boeing versus Airbus?
It's been a little quieter, if I'm being honest, for Boeing, but they had some huge orders coming into the show. You remember talking to Michael O'Leary just a few weeks back, Tom. He placed a massive Boeing order. So maybe actually, if you take it back over a few weeks, maybe it's more even Stevens. But we've seen a huge order from Indigo coming out of India for Airbus. We're going to be talking to Guillaume Faury very shortly about that order. But the real thing that everybody's talking about here, Tom, is just the fact that we've gone from nothing to everything. Lisa was talking about it. There's a possibility of a bubble forming, maybe. There's a sugar rush. Steve Harsey was in that clip just a moment ago talking about the fact that it's like kids in a candy shop. The question is, are airlines over-ordering in order to secure slots? Because both Boeing and Airbus and their suppliers, the engine manufacturers, are really supply constrained at the moment. So they're sold out until now beyond 2030, which raises some really interesting questions about how do you price airplanes in 2030?
One thing I learned years ago on this is, yes, the pricing is an art. I mean, it's just absolutely bizarre what a jet engine costs, et cetera, or a jet. Guy Johnson, how easy is it to cancel an order if you've made them? If I go out and buy 30 A320s, can I just cancel those the next year, the next 2 years?
Tom, I think you raise a really interesting question, and it's one that I'm going to put to Guillaume Faury. How tight is the wording on some of these contracts? What kind of inflation numbers are they plugging into these contracts? Where's inflation going to be in 10 years' time? These are really tricky questions that I think the airline industry is really grappling with right now. There is another way of looking at this as well. So if you look at the Indigo order, Indigo will take some of these aircraft. They're not going to hang on to them for that long. They'll sell them back into the market. So they place a huge big order, and and then they kind of trade some of these aircraft as they need them, don't need them. So there are sort of shades of grey on this one. But yeah, how tightly the language on contract writing is being pursued at the moment, I think is a key question. And what inflation rate, what's the cost of money, all of these things really hard to manage right now.
A lot of people probably are listening to this and have one question in their mind, Guy. How big is the first class, is the business class versus everything else, which is evidently shrinking at a lot of airlines?
Business class is where it's at right now. It's interesting, actually. I've talked to a number of airlines, particularly out of the Gulf over the last few days. First class is becoming less of a thing. So it's going to be a 3-configuration cabin that people are talking about now. So it'll be business class, which will be fairly epic. Then there'll be a premium economy product. Then there'll be an economy product. That seems to be the model that everybody's going with. But everybody apparently, Lisa, wants to fly at the front of the plane right now. It's the new thing.
Yeah,
you don't want to turn right. You definitely want to turn left when you get on that aircraft.
Well, I think that a lot of people want to. Whether they can afford to is another question, especially given how much prices have risen. You said fairly epic. What kind of epicness? Can you give us some anecdotes of what business class looks like now that first class isn't a thing?
Well, I think you talk to Qatar. They're certainly talking about upgrading their business class in a fairly significant way. You've got a new airline, Riyadh Air, that's just been launched here. We've just seen the livery for the first time. That's going to be a fairly big thing as well. And certainly the Gulf is leading when it comes to first class and business class. They may keep some of their first class cabins, and they are going to be cabins. But I think that you're going to see business class. Many airlines are now investing heavily in business class because they now see a different mix going forward. They see it being heavily skewed now increasingly towards the premium leisure market rather than the business class, which, Tom, I'm sure you will be quite happy to enjoy.
Well, yeah, it's interesting to see it unfold here in America. There's some outrageous stories in America about a shortage of gates at the airports and that. Guy, to your Airbus interview, which is very important. The A320 has 340,000 parts for a small airline. What's the technology right now of the big airlines? I see the Newark to Frankfurt Lufthansa Boeing 747, one of the last ones flying around, take off pretty much every day here in New York. And I'm just fascinated by where the technology of big airplanes is in 5 years. What's the new at Paris?
So you think about what's going to happen next, Tom. We are reaching the limits of current engine technology. And the old joke in the airline industry is you basically start with an engine and you bolt on an airframe. Yeah. And that is going to become more and more important going forwards. The next generation of engines are going to be a completely different architecture to what we have now. Currently, you have an engine that has a cowling around it. You have turbines within that. We could be going to an open rotor technology, so you don't have that cowling around the edge of the engine. It's going to be a kind of open aircraft. You get a big bypass going around the engine. It becomes much more fuel efficient. But then you have to basically design the aircraft around that. It's going to be a completely different format. These engines are going to be bigger. They're not going to have cowlings. You're going to have to redesign the airframes. So basically, the question is, kind of, what are engines going to look like? And then you're going to have to think about what aircraft are going to look like beyond that. And after that, we're going to be thinking about hydrogen aircraft, and that's going to be a completely different ballgame. And engine technology, aircraft technology, and the way that engines and aircraft look is going to change dramatically again. So we're going to go through some really big changes. The kind of traditional tube wing engine model is going to disappear. We're going to change that over the next few years, Tom.
Guy Johnson, thank you so much, and we look forward to his important interview with a gentleman from Toulouse here coming up with Airbus at the Paris Air Show this morning. It's amazing how this is conversations at home. Everybody that comes over, everybody ends up talking about the outrage over what flying around like Guy Johnson costs.
Yeah, well, just in terms of both the front of the cab, he was saying everyone wants to be on it, and that's what airlines have been responding to in terms of how much they're jacking up the price, and that's funding the incredible gains that we've seen. Just did you know that United Airlines, that stock is up 42% year to date? The Delta shares are up 30% year to date. It's not that surprising considering they can continue to charge these things and you haven't seen price pushback, perhaps until now.
Yeah, it's interesting you say that because yes, they're up and there's been a leg up here off the, the October bull market, or actually with United Airlines, I can go back to early summer last year off the pandemic low, 22 to 50. That's a big move. We all agree on that. But the bottom line is they haven't gotten back to some form of the trajectory pre-COVID. And we've asked Scott Kirby about this at Bastion over at Delta. How do they get, I don't understand how they get back to the profitability that we used to know. I mean, I'm looking at United Airlines. Guess what? They're making 6 cents on the dollar if they're lucky. It's like they're like a grocery store. Bananas.
This is partly because they lost a lot of people during the pandemic. They are constrained on who they can hire, and they're having to pay up. I mean, they didn't pay for a long time, and that was a big cause for concern. And so now if they're using a lot of their disposable income to go toward pay raises and other types of maintenance, I mean, this is the reason why people are wondering, when does that change?
I have a family member who works for one of the major airlines answering the phone at home. She's like senior person. She flies to London for $10. How come we don't get that deal?
You can ask her that.
She goes standby, but we'll go to London this week. Let's go to London for dinner. Futures -11. That's what Farrow's doing. He's on assignment. This is Bloomberg Surveillance.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Connection lost.
4-day lengthened work week. That's what we've got here. Bloomberg surveillance. Good morning. Let me have my glasses on. I'm blind this morning for some reason. We welcome all of you in economics, finance, investment, and on international relations. Much of that going on with Secretary Blinken returning from China as well. Futures -12. Lisa, Dow futures -110. Bond market, we had an elevation in yields. We give it right back, waiting for economic data.
Basically, we're retracing a little bit of the gains that we saw at the end of last week. But just to sort of put this into perspective, we've seen an enormous rise, particularly at the front end. On the long end, we are seeing a little bit more tempered. But this has been a reset, a shift back to perhaps higher rates by the Fed than previously expected.
Including a 7% bank rate, 30-year mortgage rate as well, and that leads to housing data. And Mr. McKee, you've got the first blush of today's and tomorrow's housing data.
It's a little disappointing that neither one of you has hats on, because I tell you to hold on to your hats. Housing starts up 21.7% last month. Building permits up 5.2%. In April, housing starts were down 2.9%. That's a revision lower. And permits down 1.4%, which is basically unchanged. But this is an enormous jump in houses under construction. Overall, 1,631,000 annual rate for housing starts, and building permits at a 1,491,000 rate. And this is just... we thought it would be strong, but there's got to be a reason why it is this strong.
There's got to be a reason. It's as simple as this, and I see it, Mike. I look at, say, Zillow. Pick the geography, Mike. There's nothing for sale. How messed up is our housing economics right now?
Well, our housing economics is sort of topsy-turvy because it should be the area that gets hit hardest by the Fed's rate increases. But you're right. There's not much for sale because existing home prices are rising because there's not much for sale, and that keeps people in place. Nobody wants to pay the new higher interest rates. But analysts say what happened after the Great Recession was everybody started building apartments instead of homes, because everybody didn't want to buy homes because of what they'd gone through. Now people want houses, and there aren't enough houses out there.
The data today, or the data mortgage applications tomorrow, whatever, Case-Shiller, whatever, can you impute or think about what rent dynamics look like given housing data? Or are they two separate worlds?
Well, they're sort of two separate worlds, except that we do know there's been a lot of apartment construction, and we do know that apartment rentors had lowered prices to attract people during the pandemic. Then they jacked those prices up a lot following the pandemic, and now things are starting to even out or go down. So we should see in the inflation data a lowering of rent prices coming up, but now it looks like we're going to start to see maybe a year from now, prices go back up again, given the time lags that are in there. But the important thing here, too, is that we are seeing enormous hiring in construction. If you look at the charts, and I'll show one to Lisa on the 9 o'clock show.
Save it for the 9 o'clock.
Save it for the 9 o'clock show, because I don't want to upset the people who are listening on the radio here. But the construction numbers are just amazing. Not only residential construction big, but we're starting to see heavy and civil construction because the IRA is starting to get some of the infrastructure projects going. And with that kind of strength in hiring, there's just one more thing Jay Powell has to keep an eye on.
14 seconds. Which Fed speaker today are you going to lean forward and listen to?
Actually, neither, because neither is talking on a subject that has to do with the economy or monetary policy. But just wait till tomorrow.
Wait till tomorrow. Michael McKee, we will wait till tomorrow, heading all of our economic coverage. This is a joy. You want to say something? Excuse me.
I just want to bring this in. It's just that the judge in the case of the former president judge has set a case for the trial, has set a date for the trial of August 14th. So it's going to be about 2 weeks starting August 14th, just for those people who are covering it. But Tom, really very much front and center right now, aside from the political drama, the housing market. My key question here is, how much have we seen the bottom, and is it really resurging in a massive way?
In and around the first debates of the Republican Party, Mr. Trump has said he will not participate in those debates, but nevertheless, there it is. This is a joy and a real sign of the end of this terrible pandemic. Peter Hooper has been vice chair of research at Deutsche Bank Securities. All of us, John Farrell, Lisa Bramwitz, and I agree. He's had the coolest remote through the COVID. He's up, I don't know where he is. It's absolutely spectacular. But we said, we want to be like Peter Hooper and be ensconced in New Hampshire or wherever. And he is here in our studios today. He is Deutsche Bank Economics with David Folkerts-Landau. We're thrilled that Dr. Hooper could be with us today. I'm going to rip up the script. Lisa's on top of some of the more current things. What were your thoughts with all of your experience at the International Monetary Fund to see this stunning 3-year and even 5-year outlook of cautious economic growth from the institution? Is that cautious view something valid?
That cautious view is very valid. In fact, it may be slightly optimistic. We're facing still globally a serious inflation problem. Central banks started out well behind the curve. They're catching up, but they have a lot of work still to do. We got a little taste of that last week from Jay Powell. I think certainly the U.S., Europe, both very much, and UK especially, looking at inflation that is persistently sticky at the core level. Mm-hmm. We've seen some significant progress at headline thanks to dropping energy prices. But research we've done in the past on disinflation says it's easy to get inflation down from elevated levels to halfway there. It's the final few miles that are tough.
Deutsche Bank has had a committed view to the Pacific Rim for years. I can remember the books would come in, the orange and blue books would come in on the Pacific Rim from Japan on down to the Deep South. Do we have a clear picture of Asian economics and a clearer picture of Chinese economics right now?
Well, China's a bit of a puzzle. We had a big bounce coming as they opened up out of COVID, a strong bounce in growth in the first quarter. Things weakening, softening significantly, and to the point where it looks like we're going to probably need they will need some policy stimulus to get things back to where they want to have them. Our team in China is optimistic. They think that households are going to be spending. They certainly, whereas U.S. households have spent down their excess savings, Chinese households have not. And they're now putting that into the housing sector. And we do expect construction in home building to be an increasing boost to growth. But it's a mixed picture, and certainly.
You talk about a boost to growth. Well, it's certainly being a boost to growth in the United States. The fact that we just got the biggest jump in housing starts going back more than a year, considering the fact that a lot of people are saying we've seen the bottom of the housing market. Do you agree? And how much of a boost could that give the U.S. economy at a time when people are still saying, wait for the recession?
Certainly home builders. We got a big surprise yesterday on their sentiment, and now the numbers today. This is a large surprise. I mean, certainly that kind of increase in construction. I'm not totally surprised. The housing sector is tight. Vacancy rates are very low. Vacancy rates are high. Very low at this point. And you're looking at a residential construction as a share of GDP that's come down sharply from the peaks that we saw just after the pandemic. We had a big boost in housing. It's come down for the last year and a half. I would say that if it weren't for the Fed and its job ahead to give us a slowdown and take care of inflation, we would be seeing the bottom. I think we probably have another little leg down, but the correction has already largely taken place in housing.
What do you think that Fed Chair Jay Powell needs to do tomorrow, the day after on Capitol Hill, to convince markets that he actually is committed to doing something after this pause that was highly confusing for a market that just doesn't believe they have the teeth to go ahead with 2 more rate hikes?
Yeah, I think I was listening to Rich Clare to describe this conundrum as both awkward and hawkish, and I think we came up with the word hawkward as Powell's performance on Wednesday. To pause at a time when you're significantly raising your forecast both of inflation and of the level of rates that we're going to have to get to deal with the problem. Powell has a tough job, and of course he has a split view on the Hill. He's going to have to sell, yes, we can get inflation down, but without a major recession coming. If he pulls this off, it'll be unprecedented for a Fed chair.
That's a really important statement. Explain I mean, all the surveys and the snark is he's a very unpopular Fed president. He's going to quote unquote pull this off. Describe what pull this off is.
Pull this off is quell inflation, bring inflation back down to something close to 2%.
Right.
Without pushing unemployment up into the 5% plus range.
Your thoughts?
It's never been done before. We've had 7 major periods of disinflation in the U.S. over the last 70 years, okay, going back to 1950. Every one of those, inflation's come down at least 2 percentage points, driven by Fed tightening. Every one of those has been accompanied by a recession. So this would be unprecedented. Now, Powell does have a couple things going in his favor. I mean, one is that probably the most important one is that the Fed, thanks to all the hard work Volcker and then Greenspan did getting inflation down, the Fed got a lot of credibility. And secondly, inflation expectations are pretty well anchored right now. Longer term, they're still not that much above the level where we were over the last decade. That makes it possible, but it's a mighty difficult task to pull this off. I mean,
Very quickly, Peter, on Clarida saying we're not going to get back to 2% or 1.8% run rate on this economy. That's going to be 2.x%. Can our institution make the shift to a higher implied inflation, whatever that number may be?
Not this Fed, not under Powell's leadership, not under the current membership. They are absolutely committed to the 2% objective. They realize that if you do this at a time when inflation's high, you're going to kill Fed credibility. That's the last thing they want to do. Powell is the second-term chair. He wants to leave with a legacy of being Paul Volcker II, not Arthur Burns II. He does not want to be the one who's remembered as having let things slip on inflation.
I'll have to leave it there. Peter Hooper, thank you so much for joining us with Deutsche Bank Securities. Just fascinating. I can't say enough about Matt Lozzetti's call on not only recession, but the whenness of it. He absolutely nailed that. Futures at -15, the Standard & Poor's 500 down 0.3%.
If you're just joining the program, the S&P a touch softer, down 0.3% as we chart a new week post-holiday. Coming up on the Open, I am going to be filling in for Jonathan Farrow, who is, as Tom would say, on assignment. I would say on vacation, well-deserved. Sonal Desai, Franklin Templeton, Matt Miskin of John Hancock, as well as Jimmy Chang of the Rockefeller Global Family Office. We're going to be talking about really how much of a pause we could potentially get. Is this a FOMO market, or is this a market that's still worried about recession? And those two incompatible truths are really clashing up against each other. You could feel it this morning.
I'm going to drag it forward to the FedEx earnings tonight. I am in the camp that logistically you have to listen to what FedEx says about the pulse of the nation.
I would
agree.
agree.
It's not a small matter.
I would agree. And is that really an indication at a time when they had been forecasting lower, right? We saw this pretty consistently, that they were concerned about people ordering less stuff. Does it matter if it's the stuff versus the services, and we keep seeing that bifurcation?
Well done, 83 cents. Are we going to revisit a 69 handle on West Texas Intermediate? $70.95, $71, let's call it, on West Texas Intermediate. Brent crude rounded up to $76 as well. I would note renminbi as well, off the radar, but important for international Wall Street. Renminbi 7.18 yuan. That's a shock.
And just to revisit this, the judge in the Trump case talking about this August 14th trial date and 2 weeks thereafter to really hold that trial. As Michael McKee pointed out, it's pretty fast. It's a very fast trial for an unprecedented case.
Well, yeah, and again, I would assume that, we'll see how that comes out, but I would assume that it has to do with the delicate nature of the evidence as well. Let's get a move on and get that fixed, whichever way it may swing. Futures at -14, Dow futures -118, the VIX 14.35. Stay with us. This is Bloomberg Surveillance.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
I think the 60-40 needs to be modernized. I think of the 40, we should add maybe 15 to 20% in different alternatives and look for equity protection strategies. And so rethink diversification. This is a critical time for doing this.
Really a part of the academic debate at this moment. Sebastian Page, T. Rowe Price, head of global multi-asset there. And I really can't say enough about how people are thinking on global Wall Street about what the new 60-40 looks like. I can't say enough about his book, Beyond Diversification. I'll be talking about that out on Twitter here over the coming weeks as well. Futures negative 14, Dow futures negative 121. It's a holiday lengthened work week. That's what we like to call it here. Lisa Bramwett's getting ready for the next hour of the Open. John Farrow on an important assignment right now. Lots of headlines coming out, sort of disparate headlines. We heard about the Trump trial. Lisa just mentioned that as well. This just out moments ago, the Secretary of State, Blinken, speaking in London, announcing more Ukraine assistance tomorrow. We'll keep you up to date on these many international relation headlines through the morning. The 10-year yield is 3.77%. If you're a retail investor in your yield hog, you're looking at a 20-year duration, 30-year muni bond, whatever it may be, to grab that yield. And you have been absolutely slammed over the last 24 months. The Bloomberg Total Return Index down anywhere from 13 to 15 to 17%. An end of the great bond party. Megan Swiber is extremely acute at this with Georgetown Finance and Mathematics, Director of U.S. Rate Strategy at Bank of America as well. I'm going to start with a basic retail question. It was up and away for 10 years, 15 years, whatever. We got absolutely slammed, price down, let's say 15% to be kind. We've come back a little bit. Now what?
Yeah, Tom, I think this is really the question on everyone's minds right now. You know, you have yields at relatively attractive levels, but is now the time to be buying? And what history tells us is that you really need to wait until that final Fed hike of the cycle to feel more comfortable and confident going long duration at this point. And what we see from investors, the survey that we conducted at B of A, one of them is this Global FX and Rate Sentiment Survey, which is a really cool survey of global benchmark investors, has a pretty long history, 2 decades or so. And that tells us that right now, investors have more confidence being long U.S. duration than they have really at any point in time during that survey.
Give us a maturity time on this. I mean, let's frame this out. The Fed is at the 2-year space. Yeah. The belly of the curve is 5 to 7 years. Long duration, does that click in at 10 years or is it a different maturity?
Well, I mean, you can think of it across the curve. Really what you see, though, and what we've been guiding investors towards is when you're talking about long duration, you're talking further out the curve, 10-year, 30-year rates. And those are more limited in terms of how much they can increase on the back of the Fed continuing to hike versus the front end of the curve, which will be pulled higher with the Fed delivering more rate hikes likely.
The problem I have with this is everybody likes to talk spread market and all these other professional distractions. I get it. Everybody read Fibonacci. I'm dazzled. Forget about it. The fact is bonds went down 15%, just as a round number. 100 became par, became 85. That's all there is to it. We've come back a little bit to 87, 88, 90, whatever that number is. Are you as a bond investor investing for total return, or somewhere out there you get back to what we remember, or is this the new level we're dealing with?
I mean, to me, Tom, the answer to that question comes down to the inflation outlook. And right now, if you look at market price and kind of following up on the prior segment here, the market has a lot of confidence that the Fed's going to be able to see inflation back down to 2% in a year. And if indeed that is the trajectory, then you are probably going to see down. Exactly. Yeah. You're going to be able to see the Fed cut alongside that. But
the other thing you say in your research note is issuance, and this is where all my radar's up. Lisa and I talk about this all the time. What are CFOs going to do in this milieu? I mean, to me, you know, there's going to be the big guys call up. They make 4 phone calls, including the Bank of America, and they sell a gazillion bonds. But is a total, what will CFOs do on issuance?
Yeah, I think that is another important question here. And on the back of this repositioning that we've seen from investors more broadly, what you have Treasury doing now that we're beyond the debt limit is increasing issuance. This first wave is going to be in bills, pretty easily absorbed, because if you look at the Fed's overnight reverse repo facility, you got a lot of cash sitting on the sidelines that can go out and buy that. But the question here, right, is this longer duration stuff, 10 years and out. Who are the marginal buyers of that going to be? And I think at the end of the day, that's another risk to this very consensus view in the market that we currently see, which is wanting to be long duration at these levels.
But the consensus view, if I was to frame this as simply as we can, you're going to look out to 10 years, which seems forever away, 2033, 2034. You're going to buy it, and you're going to clip the coupon. If the price goes down, you've still got the coupon to carry to help you. But the hope and prayer of the market now, the consensus is price up along with that to a really pretty significant total return, right?
That's exactly right. And again, you know, if the Fed is able to see the inflation levels that the market expects at this point, it makes sense for the Fed to get towards a more neutral policy rate setting, call it 2.5%, 3%, which means that you're going to have downward pressure on those yields at the back end. But really the challenging thing and the risky thing for investors is stickier inflation. And currently the Fed really doesn't have a lot of confidence in their forecasts. We don't think that they're going to stop hiking until they see core CPI coming closer to 0.2%.
Right.
We're at 0.4.
So what's your 10-year call, year end or 1 year out, whichever way you frame that a bit?
Yeah, so year end we have 350, so a bit lower than the levels that we're currently sitting at. And that is really due in part to the fact that we're going to be beyond the Fed's final rate hike of the cycle. And you're going to have more conviction on what the inflation outlook will be. But in general, we're not expecting this very massive fall in rates. It's looking near term like you're pretty much going to be sitting in this range between 325, 375.
I don't know if you get into portfolio construction. I got like 8 ways to go here, folks, with Megan Swiber. But the answer here is, it's real simple. Do you single point, do you barbell, or do you ladder out maturities if you're scared stiff of the...
Yeah, and that's the important point here too. Rates, duration in portfolios is the world's risk-off asset. And if you have more of this pressure here on the equity market, you're more inclined to see rates be that buffer, be that hedge. A key point here, though, is whether or not we're going to see this recession that many economists were calling for at the start of the year.
That's worked out.
The data's been so resilient, right? The U.S. economy is just a lot more resilient than what the Fed, what economists more broadly were ultimately giving it credit for, which limits how much you can really see the equity market fall and rates fall alongside it.
I got to go out to the long-term space. It's great when you see Apple Computer put out a 30-year piece or whatever, and it's sold in 2 seconds. As well. What is the plus minus of long duration full faith and credit right now?
Yeah, I think you have to be a little bit more humble about how far rates can fall. The Fed, when they were implementing the flexible average inflation targeting strategy, a big part of that, right, was being able to see nominal rates move higher, be able to build in some buffer when they're cutting. So I think that the probability that the Fed cuts down to the zero lower bound is more limited here. You probably have to think that in a Fed cutting cycle, when we're in more of this mild recession, is closer to 2.5% than it is falling all the way back down to zero.
I mean, I'm looking here, and it's amazing how this is the trap, folks. You got to be careful here. As many of you know, I bought the 100-year Austria. It's like now a 97. I'm down 70% in that piece right now. It's on the mat. I mean, even with some of the constructive things of Europe or whatever, the Austrian 97-year piece is still, it hasn't come up. That's a trap you're talking about on a less, inflammatory basis.
Exactly. And I mean, I think near term, you have more potential for the front end to be more volatile, move higher with the Fed continuing to hike. You see the market only pricing about another 25 basis point hike over the next several months. If they deliver on 2 more, which is our base case call, you're going to see more upward pressure on the front end of the curve. So we think that investors who've really been positioned for the end of the hiking cycle, which is curve steepeners, long duration, you need to be careful here. And I think a good way to hedge this is to push back on what the market's pricing for inflation.
The way to hedge it is to buy NVIDIA, right?
Yeah, I can't comment on that.
She's got Megan Swiber. So thank you for compliance for Bank of America. I can state Megan Swiber did not comment on NVIDIA as a bond alternative with Bank of America. Coming up, an important interview, our Guy Johnson in Paris with the Chief Executive Officer of Airbus.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
In the middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He caught himself
self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Ferro. We are seeing perhaps a pause to the FOMO, the perpetual gains that we saw for the past 8 straight weeks on the NASDAQ. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Coming up, investors caught between FOMO and fear of an overheating market. Powell heads to Capitol Hill this week to face questions about the Fed's confusing pause and China's recovery, losing steam as its property and housing sector struggles. We begin with the big issue. Stocks take a breather after the longest stretch of gains since 2019.
We do have to take into context the strong rally that we've had so far.
It's a very narrow stock market. The leadership, as you know, is too narrow.
Very narrow, tight, speculative leadership.
It's been so centric to big tech and a couple other industries.
Once the S&P broke out, then you need a hook, right? So the hook was AI.
AI-driven stocks are giving us a boost.
It's also a huge question mark. I'm not sure why we can't get this broader market rally.
This is not what bull markets are made of.
I wouldn't be marking this as the start of a big bull market.
There are headwinds.
The real data under the hood is ugly. I'm very concerned that we are going to see a hard landing.
The market's having a little bit of a summer fling that ultimately ends in heartbreak in the fall.
We're not out of the woods yet.
Joining us now, Franklin Templeton's Sonal Desai and Matt Miskin of John Hancock Investment Management. Matt, I want to start with you. You said that, in your view, the biggest risk to the market today is a lack of risk being priced in. What are you saying when you talk about that, given the run-up we've seen so far?
Yeah, Lisa, when you think about the VIX at 14, high yield spreads at 400 basis points, and now the PE ratio on the S&P 500 reaching a one-year high, about 19x, there's just not a lot of risk being priced in. And right now, the time to fix a roof is when the sun is shining. When we look at portfolios that have been overweight risk, that have actually done well this year, you've had to have real risk on to do well and outperform this year. We would look to trim into some of this strength and redeploy into higher quality fixed income, take some chips off after such an exceptional run.
Sonal, do you agree with that? Is that sort of your sense that perhaps it's gone a bit too far at this point?
So here's the thing, Lisa, I'm not going to comment on the equity market, but I would say on the issue of higher quality, we have been positioned that way for a while, but I would not confuse higher quality automatically with longer duration already. I know that accepted wisdom at this point is that duration will rally from here, but I actually am not sure about that at all. I still see the market pricing 150 basis points of rate cuts starting already from the last quarter of this year. That's too much too soon.
So, Matt, to that point, what is sort of the defensive trade? What are the safer, more conservative areas to hide, especially given the fact that we do still have a pretty sticky inflation? And a lot of people have been talking about some of these tech names that have driven the rally as being the havens, as being the defensives.
I know, right? And I think quality as a factor is working in the equity market, which would usually translate to the bond market. What's interesting in the bond market right now is CCC high yield bonds are the best performing part of the corporate bond market. So it's high yield, it's bank loans. There's very little higher quality parts of the bond market that are outperforming. And I think for us, that looks like an opportunity. We're looking at the investment grade bond market at around $89 price, weighted average price, $100 being par. They're trading at $11 discount. We're looking at 5% in yield, and we're more okay with the duration. When everybody hates duration now again because all the rate hikes have been priced out and we're back to nearly the 10-year yield we started the year at, we think there's more value. not less. So we would actually look at duration. We're more intermediate. I'm not talking about super long duration, but just intermediate duration we think will actually work in your favor after this repricing.
So now to that point, a lot of people have been talking about the fact that inflation is coming down. The Fed is determined to fight it. And even if the Fed does hike another 2 times this year, that still leaves us with lower inflation over the long term. Why is it that you still see duration as potentially selling off?
Well, in part, when we say inflation, it's not a single thing, right? We're looking at core inflation. Core inflation is pretty sticky. It's been stuck where it is right now for over a year now, practically. Talk about a few tenths up, a few tenths down. Core inflation is sticky, and I think there's still a lot of work to be done, and the Fed is actually going out of its way to show that it's committed to bringing it down. So from my perspective, the piece that I don't hate all duration, let me be clear. I do think on the intermediate side, it starts looking very attractive over the coming few months. I just think that the market still needs to internalize that the Fed is not going to be racing towards a series of rate cuts. So we're still not really listening to what the Fed is telling us. I think that's my point.
And that's something that we heard about that earlier this morning as well, that perhaps people are still fighting the Fed. And there's this feeling that if the Fed does keep rates higher, Matt, that will impede some of the valuations here. Is that one of the risk cases here? Or do you think that it's just simply that people are not pricing in a landing of any sort? They're not pricing in any kind of pain inflicted by some of these rate hikes?
Yeah, Lisa, I mean, in your seat, you must hear this all the time, the merry-go-round of no landing, soft landing, hard landing, back to no landing all over again. And you and John probably just sit here and just like, wow, this is amazing to watch. But what we're at right now is the no landing component. And so if you look, when we talk to our rates strategists here and we talk about our portfolio managers positioning, what they're looking to do is incrementally add duration when the 10-year is at the higher end of this range and trim duration at the lower end of the range. And then when a recession is more at our doorstep, which we frankly think could be at the end of this year, that's when you just want to increase duration more. So we're in this trading range. It can be really tough. It's choppy. You're going around and around in circles. We're just being disciplined. We're not taking a massive duration bet yet, but we are moving up in quality. Frankly, it's hurt us thus far. But the more that we see global economic data slowing, the more we're feeling comfortable with that positioning.
Sonal, are you also trying to sort of trade in this range and sort of this uncomfortable mishmash of uncertainty ahead of some sort of more decisive turn in terms of understanding whether the Fed is perhaps getting its message through the market?
I would agree. Actually, I really agree. It isn't a comfortable market. There is no doubt about it. And I think all the volatility in the fixed income markets, it's not going to go away until the the market actually hears what the Fed is telling it. In terms of the risk that I see to the outlook we just heard, it would be that, yes, the economy starts slowing, but core inflation is still sticking at 4% plus. And that puts us in a fairly difficult place because I think the economy is going to need to slow down, but the Fed is not going to swoop in to start cutting rates. And that means for a while, we might not see the long end rallying the way markets would like to see that long end rally. So it becomes more of a situation where you get the income from fixed income, but you're not necessarily going to make up all the total return losses that we saw last year in a fell swoop. You spoke about fear of missing out a few minutes ago, and I think that does affect fixed income as well. But this time around, we might not see that V-shaped recovery in terms of total return as far as fixed income is concerned.
Stuart Kaiser over at Citigroup would agree with you. He basically talked about how perhaps in equity risk land, there is this sort of momentum upward, and that's probably the place of least resistance going over the next few weeks. That said, he said the biggest risk is sticky inflation, and talking about the potential for the Fed to continue hiking and what that does. He said, for now, Fed speak is the barometer for this risk. Matt, we get a lot of Fed speak starting tomorrow with Fed Chair Jay Powell on Capitol Hill. What are you looking for? What are you expecting to hear that could potentially be a sort of seminal moment for markets?
Yeah, I just think Powell really punted on the July hike certainty, and Lagarde didn't. Lagarde's like, look, we're going in July. And Powell's kind of like, well, it's a pause, it's a skip. I don't know. There's a Freudian slip in there, maybe even. But at the end of the day, I think you want to harden up that July hike. Make sure that the bond market listens. I think it's been a communication dropping of the baton here, and we need to get it back in line. And I think they didn't do themselves any favors, frankly, skipping. They probably should have hiked. You saw the housing data this morning, Lisa. I mean, it was too hot. And Powell even said, well, we're not just looking at housing. They probably should be looking at it. To Sunil's point, the stickiness is the housing market. And if they don't get that under control, they're going to keep having problems.
So let's say, Matt, just to sort of double down on that he does come out and he says, look, to be very clear, we were concerned about a couple of things. In retrospect, especially after seeing this housing market data, unclear whether we should have probably skipped, paused, whatever you want to say, or whether we should have just raised rates. What's the market response? How significant is it?
Yeah, I think the stock market at least starts waking up to the real yields in the 2-year, and that the short ends come up so much. And I think that does present more volatility. And so, you got to have other options besides high quality tech in the equity side. We look at mid cap value, the onshoring piece, that's actually driving some of that housing data. That we think is a nice complement if you do see a rotation out of some of that tech stocks that have just run so hard on what would have been usually lower rates, but it hasn't been happening.
Sunil, what's your sense of that? I mean, do you agree that that's sort of going to be the communication from him and that's going to be the market response?
Well, I think it's on the communication side. I think Powell probably remembers he essentially signaled and the market priced 575, and then 3 days later SVB went down, and then 10 days later they had to come out. I think he might be a bit reluctant to literally come out and say that, but we've got a host of Fed speakers between now and Sunday, including Powell, and I'm pretty sure that they're all going to be pointing in the direction that Matt was talking about. And in that environment, I think his call on markets is probably correct. The question is to what extent bond markets start repricing as well. And so far, they've been really reluctant to price out rate cuts.
Yeah, that's been something that we've seen. To Matt's point, Sunil, how much is the housing data that we saw this morning a massive upside surprise when it comes to housing starts, as well as building permits? How much is that going to underpin some sort of Fed move when they categorized it as a weakening market in the previous press conference?
I think they will probably not comment on it. It is a single data point, so I wouldn't be surprised if they just skipped talking about the housing market. There's no doubt that this is strong data, right? It continues to feed into the narrative that, on the whole, housing, new starts especially, are not going to be the first place which collapse, maybe because there's a massive underlying shortage in terms of deliverability of housing. So I would just say that on that, they may choose simply not to address it, though there are so many speakers. Again, somebody will have to.
Sunil Desai, Matt Miskin, both of you are sticking with us to push the day forward as we do chart toward the open, which is in about 18 minutes. Joining us now with a look at the stocks moving ahead of that, here's Abigail Doolittle. Abby.
Hey, Lisa. Well, we do, of course, have the futures down just a little bit. But before we take a look at what's dragging, let's look at one stock that's popping. That is PayPal. This is KKR has agreed to buy up to 40 billion euro of PayPal's pay later loans. That equates to about $44 billion. And PayPal expects $1.8 billion in proceeds from the transaction, which they could use for buybacks later this year. To the downside, though, we have Nike. Morgan Stanley sees inventories weighing on margins. Channel checks in both North America and Europe are showing Morgan Stanley this. And then Palantir off the lows, but down about 1%. This is Raymond James. Downgrades to a outperform from a strong buy. So it doesn't sound like so much of a downgrade, Lisa, but the analyst there is citing valuation, noting that the stock has soared more than 120%, like so many other stocks this year, but in this case off the May low.
Abigail, thank you so much. Coming up, as we were just speaking about, another big week for the Fed with Powell heading to Capitol Hill.
I don't want to deal with hypotheticals about different ways data might move out. So we of course we don't go out of our way to surprise markets or the public. At the same time, our main focus has to be on getting the policy right.
As Peter Hooper of Deutsche Bank said, it was awkward when they took a pause. From New York, this is Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. We are strongly committed to returning inflation to our 2% objective.
Another big week for the Federal Reserve Fed speak, plus Chair Powell heading to Capitol Hill, where he likely will be grilled about last week's rate pause. Meanwhile, Fed Governors Jefferson and Cook, alongside U.S. Representative to the World Bank, Adriana Kugler, they are set to face the Senate Banking Committee as part of their confirmation process. Joining us now is Bloomberg's Michael McKee with more. Before we get to all of the Fed speak, Mike, just in the data that we got this morning, how much does that really undermine this idea that perhaps there is this immaculate disinflation that is picking up speed?
Well, it sets the stage for some interesting questions, Lisa, and it does sort of define the way Jay Powell has to do his job. First, let's take a look at the calendar. You're right. Tomorrow's the big day with Jay Powell and the members of the committee going through their nomination hearings. And then on Thursday, Jay Powell again. The others are not necessarily talking about monetary policy. Loretta Mester has one speech on that. So if you pay attention tomorrow, you'll probably get as much as you're going to get for the week. Now, to the data we got this morning and how it fits in. While housing starts rose 21% in the last month. And look what that means for the economy. Overall, in blue is the number of construction jobs, and in white, the number of housing construction jobs. They've been very, very strong. And now look at the yellow line. That's the heavy and civil engineering jobs that are getting put in place by the IRA, the Infrastructure Act that Joe Biden passed. And we're seeing the kind of hiring that's still going on that is going to boost the economy and keep it stronger, perhaps, than people think, which leads us to this, and this is just a follow-on from that chart there. These are lumber futures. Notice how they've been coming down, and now they're going back up again. Inflation could be sticky. So Jay Powell has to deal with Democrats saying, look at all those jobs that have been created, don't get rid of them, and Republicans saying, look at inflation, you got to do something to bring that down. What does Jay Powell say about both of those things? We'll see if he has anything more than he offered in his last press conference last week.
Michael McKee, you've been talking with a lot of different economists. You have a great intel into basically the zeitgeist of that field. How much do people believe that a pause was a mistake, that they should have hiked last week?
Probably got about 50-50. A lot of people think that the Fed has probably gone far enough because the cumulative response to all of the interest rate increases that they have done has yet to hit the economy. And then there are others who think that if you were going to raise rates, just do it, because dragging it out isn't going to help. If the economy really needs that additional 1 or 2 rate increases, sooner would be better. But right now we've got the skip. We look ahead to July and what they do then.
Michael McKee, thank you so much, as always. Still with us, Chanel Desai and Matt Miskin. Chanel, from your vantage point, what are you looking for to confirm or, frankly, to rebut your feeling that there is this stickiness that the Fed's going to have to deal with for a lot longer than just simply the remainder of this year?
So if I'm looking for, it's not so much feeling, it's the data. You know, honestly, I know that Powell has said that probably you don't have too much wage inflation at different points in time, but we've got just about enough to maintain that sticky base of inflation. And once again, we're in the situation that every month there is a special reason for core inflation to be higher. Either it's used cars, and then used cars are going to come down, but then it's something else. And ultimately, it's inflation. And it's been what we've been living with now for a couple of years. So to me, I need to see that inflation data come down decisively. I don't think the labor market is going to collapse, because that would be an indication that a reduction in inflation was on its way. We're just not going to see that yet. I also happen to think that long-term interest rate, that the Fed, long-term Fed funds rate, actually needs to be closer to 3.5 to 4 rather than the 2.5 they seem to be programming right now.
Wow, that's a pretty big call. Matt, your view, 3.5 or 4% basically end rate or neutral rate going forward. Does that jibe with your sense?
So we think that we're going back to a low inflation, low growth world in terms of at least the U.S. economy and frankly global economies, and that would bring actually interest rates to a lower endpoint. You know, so structurally, not much has changed. Demographics are still a major issue globally. What we did was we spent $5 trillion. We stopped and started the economy through COVID, which was a once in a century type event. And what we see is actually recency bias or anchoring in terms of thinking that this is a new regime of higher interest rates, higher inflation. In our view, we'll take the other side of that, that it actually is going to be falling as basically all that stimulus runs out, the spending eventually slows down and normalizes, the jobs market's already started to normalize. You bring this all back together, we're back to where we started in a lower growth, low inflation world.
Matt, do you care about Fed speak at this point, or is it just the data that you follow and that you track?
Well, Lisa, it's an interesting combination because, yes, there's, of course, the Fed speakers, but what's been driving yields higher as of late really hasn't been as much the Fed. It's been other central banks, whether it's a Bank of Canada coming out with a surprise rate hike. The UK has bond vigilantes coming out almost every other day, pushing up global yields. And so it's not been as much the Fed, it's been other central banks doing the Fed's job, frankly, in raising rates and in putting tightening into the global system. But then on the other hand, you got China putting stimulus and cutting rates, and yet the US bond market doesn't care about that. And it doesn't seem like many bond investors do, even though the second largest economy in the world is worrying about deflation and is cutting rates. Someday that might actually be brought to the United States as an export. And eventually we think the Fed and other central banks are going to have to be weighed down based on this global growth slowdown. So it's not as big of a deal as it once was. Global central banks are taking more of an important role on U.S. yields as well.
Chanel, final comment on that?
Oh yeah, Matt, you've got to give me a chance. Recency bias depends on your definition of recency. I'd say the market is suffering from recency bias, and that's over the last 15 years when we've had real rates on average at around 0.5%. Pre-global financial crisis from the 1950s, real rates ran at around 2.5%. To get to 2.5, you need to get back to real rates being 0.5% in a 2% inflation world. I just don't think that's where we're going.
Well, I do want to get Matt's view, although we do unfortunately have to leave it there. Chanel Desai and Matt Miskin, both of you, thank you. I'll have to bring you back on to have a battle of the long-term inflation expectations and Fed rates. One basic assumption that, frankly, is one of the pivot points for so many investors. Coming up, the morning calls, and later, Jimmy Chang of the Rockefeller Global Family Office joining us around the opening bell right now, heading into a new holiday-shortened week with a sense of perhaps a shift downward after 8 straight weeks of the NASDAQ gaining. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
FOMO trade taking a breather about 35 minutes or 5 minutes ahead of the opening bell. We are looking at a softer tone. S&P down 0.3%. NASDAQ just trying to catch up as we really come off one of the biggest winning streaks going back to 2019. Bonds, you're seeing a bit of a lift higher in two-year yields, 4.72 as people reassess ahead of Fed Chair Jay Powell starting tomorrow. First up, let's take a look at the morning calls. Citi upgrading Philip Morris to buy with an $117 price target, expecting stronger momentum following a lackluster first quarter. Next up, Raymond James downgrading Palantir to outperform from strong buy with an $18 price target. The analyst struggling to find a near-term catalyst. And finally, Truist lowering its price target on Humana to $530 from $590. The analyst citing the company's commentary around an uptick in utilization. Coming up, the bear case. Jimmy Chang of Rockefeller Global Family Office joins us around the opening bell. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday. 27 seconds until the opening bell. We are seeing a softer market after 8 straight weeks of gains. We are seeing S&P futures leading the charge lower, down about 0.4%, the same as the Russell, with a little bit lower of a gain for the NASDAQ 100. In bonds, no drama ahead of what we're expecting to see from Fed Chair Jay Powell. We are seeing yields marginally higher at the front end, lower on the long end as people chart out the fight for the Fed to bring down inflation. 3.74% on the 10-year. Crude is lower by just a touch, 1.2%, $70.95 traded on the NYMEX. And a bit of dollar strength, but this has been bouncing around all morning versus the euro after a pretty big week last week in terms of euro gains. What we are seeing is one stock at the open, Alibaba, the Chinese e-commerce giant, seeing a C-suite shakeup. Analysts at Forsyth Barr Asia writing that the move brings, quote, old management back to the stage, saying, quote, not sure whether it is a good thing for Alibaba, given now the key should be new growth drivers and the restructuring plan. Abigail Doolittle is back with us. Abby, what's the latest?
Well, Lisa, investors seem to agree with that uncertainty because the stock is down despite the fact that we have this announcement. Now, of course, we've all known for months that the company is planning on breaking itself into 6 different pieces, including the cloud and other pieces, hoping to juice growth and profitability. This stock now down more than 70% since its peak back in late, I believe it was 2021. And that was, of course, when Jack Ma went into hiding in Beijing, all of the tech regulations there. But the question is whether or not the new chairman, Joseph Tsai, a longtime confidant of billionaire co-founder Jack Ma, can bring the growth and the profitability desired. And in terms of these different companies, spinning out 5 could, in fact, IPO. But with the stock's reaction being down, it seems as though investors are not clear that the path forward is clear. It will be an interesting one to continue to watch, Lisa.
Thank you so much, Abby. Let's take a look at retail, particularly Nike. Shares falling from a warning after Morgan Stanley said there are concerns about inventory problems. The analysts writing that slowing demand has left a, quote, sizable inventory glut across the industry that is currently being promoted away. Let's get a sense of that. Turning to aviation, Boeing, just one of the many names making moves at the Paris Air Show. The company signing a firm order with Air Algérie for 8 737 MAX 9 aircraft. Meanwhile, Boeing says it's prepping to accelerate 737 production soon after a recent supplier issue slowed deliveries. Katie Greifeld joining us with more. Katie.
So this is the first firm order announcement for Boeing at this year's Paris Air Show. Of course, the order is for 8 737 MAX 9 aircrafts, in addition to 2 converted 737 flights. And of course, these are 2 companies that have worked together since the 1970s. I'm not quite sure if I can nail the pronunciation here, but Air Algérie is also considering wide-body purchases to expand in the future. So some good news finally for Boeing at this Paris Air Show. And it's not just the airline, of course. You also had aircraft leasing company Avalon announced today an order for 40 737 MAX airplanes. That's its first 737 MAX order since 2017, so a long time coming there. Boeing shares not moving too much today, down slightly less than 1%. This is a company, though, that is up 60% over the past year, Lisa.
Katie, thank you so much. Turning to the automakers, EV maker Rivian joining legacy automakers like Ford and GM, signing an agreement to join Tesla's supercharger network. Ed Ludlow with more, joining us now. Ed.
Yeah, good morning, Lisa. Rivian shares up by more than 2%, pushing towards their highest level since April. It is a domino effect. Rivian signing an agreement with Tesla that A, would see them adopt the North American Charging Standard, or NACS standard, in production models of their current generation R1 T1S and then future generations of the R2 from 2025. In the interim, Rivian drivers will have to use an adapter, but they will have access to the Tesla supercharger network in in North America, around 12,000 superchargers. Interesting, though, to see the reaction in both Rivian shares up 2.3%, Tesla slightly higher, about a percentage point. But Rivian will still continue to build out its own network of chargers, which will be based on the CCS standard. So they're doing both, going with the Tesla technology like GM and Ford, but continuing to build out their own network as well.
Thank you so much. Meanwhile, FedEx set to report earnings after the close today, a key indicator, especially because it's expected to report lower earnings year over year, with investors likely focusing on guidance into the next year. Joining us with more is Kaylee Lyons. Kaylee.
Well, Lisa, yes, earnings are expected to be down 29% from the fiscal fourth quarter period a year ago to $4.87 a share. And revenue was seen falling about 7% as the demand this company enjoyed during the boom times of the pandemic has faded. Now, it is worth noting in the prior 2 quarters, FedEx has beaten expectations quite remarkably. It was 26% higher, the profit in the period in March than expectations. So we have to keep in mind that there is the possibility of a repeat there. We'll see whether or not that is the case today. But as you alluded to, it really is going to be the forward guidance that is going to be key. How much profitability by cost cutting does this company realistically think it should capture, especially in the express business? What kind of margin expansion there could we see? That is something our own analysts here at Bloomberg Intelligence are paying special attention to. And of course, we'll also be paying attention on the call to any real commentary around the demand picture and the health of the economy. As you said, this really is a bellwether company. It's also worth noting that up to the report today, this is a stock up 35% on a year-to-date basis, and ahead of the print after the bell today. We are adding just slightly to those gains, up just about 0.25% here in the first few minutes of trading, Lisa.
Kaylee, thanks so much. This is going to be a really important indicator, especially because it is viewed as an economic bellwether. On that front, Jimmy Chang of the Rockefeller Global Family Office has been cautious in his outlook, writing, quote, "The strong risk rally since mid-March was fueled by a temporary surge in liquidity. Fundamentals have actually decelerated further during this period. Various leading indicators are still pointing to a recession later in the year, which is our base case." I'm so pleased to say Jimmy Chang of the Rockefeller Global Family Office joining us now. Jimmy, how much pushback do you get at this point when you double down on a more cautious approach?
Landing camp, so it's getting less popular of a call. But recall at the start of the year, the consensus was that the U.S. economy will probably fall into a mild recession by mid-year. That turns out to be wrong. In fact, consensus was way off on all these other calls, such as the great Chinese recovery, such as Europe will avoid a recession, such as banks will be strong in a rising interest rate environment, and tech will continue to be hurt by rising interest rates. All of them failed to work. So it just shows to, it goes to show that consensus very often could be off the mark. And certainly at this point, I do think the optimism may be overstated.
What do you think it is to be defensive right now, Jimmy, when we're talking about the potential for duration to also sell off if people do revise upward, how sticky inflation could be?
I actually think inflation will probably surprise on the downside just looking at the money supply. As you know, M2 is in contraction for the first time since the Great Depression. Now, we know that the overall money stock is still very elevated versus the pre-pandemic level, still above trend. But I do think this continued deceleration or contraction in money supply will place pressure on inflation. And in fact, when you look at real-time indicators such as trueflation measures, it's in the 2s right now, around 2.5%, coming down from about 12% a year ago. So I do think inflation is not going to be the issue. Ultimately, it's going to be the recession. And in fact, recession has been the way to slow down inflation in the past. And I think the Fed, most likely has already over-tightened.
So if you think that the Fed has already over-tightened, then why are we still seeing earnings that to some degree are surprising to the upside, and resilience in things like the housing market, where we got such incredible surprises, again, to the upside earlier this morning?
Yes, certainly on the housing side, if you look at the volume, we're down about 30% from a year ago. So there's a shortage of inventory. Certainly, that's driving up new construction. So that's certainly positive to the economy. As far as earnings are concerned, people are optimistic about so-called the rising earnings expectation. When you look under the hood, what has taken up the earnings expectations were the first quarter outperformance in an environment of strong, resilient economy. Analysts actually have taken down forward earnings expectation for Q2 through Q4. And in fact, the market is still carrying a 10% earnings growth expectation for Q4. Now, if we do have a recession, I don't think we'll get anywhere close to that 10% number.
What's your view, Jimmy, of this idea that artificial intelligence can sort of take this tech sphere out of the boom-bust cycle of economics and really move it into some sort of sea change in how we do business and which companies will reign supreme? Do you just reject it? Do you think it's overplayed? Or do you think that this is something real, even if you do shift into duration and make some of these more conservative shifts on the edges?
I do believe that artificial intelligence is truly transformative. So was internet and its outlook back in 1999, and then we went through a huge correction in the early 2000s. I recall in 1999, so many companies would come up with press release. We're now an e-commerce company, and the stock will pop 10 points a day. I just looked at ChatGPT this morning for some inquiries. So is my market value higher now because I'm using AI? It is a tool. I do think it is going to be tremendously of a boost to productivity, but it will take time. Plus, the way to use AI is very different from traditional software. If you put in the same set of inputs into a traditional software program, you get the same output every single time. But with ChatGPT type of artificial intelligence, you're training it. There is an element of unpredictability. So companies need to adjust to how you train the technology to make use of it over time. It will take time.
So at that point, do you think that there's going to be sort of a catalytic event when you do have companies, the AI-driven companies, at least when it comes to their gains, come out and say that they are not necessarily seeing the earnings boosts just yet? Do you think that that's going to be sort of the tipping point in markets that have been turbocharged by that promise?
I think ultimately the tipping point for the market is the economic cycle and earnings expectations. Now, historically, we've looked at cycles going back to the 1920s. In every recessionary period, from the starting point of the recession, starting month to the market trough, on average, it drops about 28%. The median was 22%. And the reason is because earnings come down during a recession. Now, this time around, we may just be different, but I'm kind of old school. I look at the leading economic indicators. They're pointing to a recession. I look at forward indicators such as the policy, on the policy front, student debt repayment coming in the fourth quarter, late third quarter, along with potential depletion of excess savings. In fact, I would argue, if not for the excess savings, we would already be in a recession. And the San Francisco Fed estimates that we have about $500 billion of excess savings at the end of the first quarter. That came from about $2.1 trillion in the summer of 2021. So for the remainder of the year, especially during the summertime, we'll probably benefit from the use of this excess savings for vacation. People still consume quite a bit, but at some point that gets depleted. So when we look at the 1-2 punch of the student repayment coming in the fourth quarter and the potential drainage of the excess saving, down to zero, that's quite a bit of headwinds.
Just want to bring this to you, and before we continue our conversation, there is this breaking news coming from the New York Times and CNN saying that Hunter Biden will plead guilty to some misdemeanor tax charges. And the Department of Justice is charging Hunter Biden with federal tax and weapons offenses. This from the Associated Press. He is expected to plead guilty to 2 minor tax crimes and admit to a gun charge. We will be talking about this coming up as we talk about some of the political headwinds domestically here in the United States. Just once again, this is the son of current President Biden. He will be charged with federal tax and weapons offenses by the Department of Justice. We're speaking with Jimmy Chang of the Rockefeller Institute and investment firm. And I'm wondering, Jimmy, from your vantage point, as we talk about some of the domestic headwinds, how do you account for it in investment theses in terms of both the election coming up, in terms of the international relations with China, and how you game out what exactly the center of gravity is going to be?
Well, I think the market has already discounted the more difficult relationship with China. And obviously, everyone's worried about potential black swan events, such as an attack on Taiwan. That's obviously difficult to position for, and you don't know when that could happen. So overall, on the international relationship side, I'm actually more worried about what's happening in Ukraine. At least so far, the news flow, which has been very mixed and confusing, seems to indicate that the much anticipated spring offensive is not going well. So what does that mean to the contour of how things play out in Europe? And there's also going to be another winter. And is Europe going to get a break again from the warm weather or not? Because certainly the Russian gas flow, the natural gas is not yet flowing back, to Germany. So potentially there's some issues out there.
And so when it comes to domestic politics, Jimmy, do you basically discount it and what that is going to mean for fiscal spending heading into the next election, let alone the international picture, but really just in domestic in the United States?
I think the Biden administration, through the Inflation Reduction Act, has really loaded so much stimulus going into the election year. And I do think the House Republicans are trying to curtail some of the spending, and that's a potential budget battle later in the fall. And obviously, the election next year will be extremely contentious. And I do think in the long run, that has an impact on psychology, on valuations, because there is the sense that America is currently being mismanaged.
Jimmy Chang, thank you so much for taking the time. Coming up, China in focus as the U.S. decouples and Europe de-risks.
I think there's no way around dialogue. Dialogue is super important to do that, to get back to the table if you want. I wish sometimes, as I lived a lot in Asia, that the Germans also understand that it is not always better or worse, it's just different.
That conversation coming up next will also be touching on Hunter Biden and the latest from the Department of Justice, as well as the trial date for the former President Trump. From New York, this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more, but
that's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
This is Bloomberg The Open. Breaking news, the Justice Department has charged President Joe Biden's son, Hunter Biden, with federal tax and weapons offenses and will plead guilty. Bloomberg's Kayleigh Lyons is back with us in Washington, D.C. Kayleigh, let's just start there. What the latest charges are, what the allegations were, and what our understanding is about what he will plead.
Well, the charges, Lisa, as you said, were related to both tax and weapons violations. And we do understand, according to a court filing, that he will plead guilty to 2 misdemeanor charges related to those tax violations, not paying his taxes on time. But under this deal, he would not avoid prosecution on the separate gun charge, which was an allegation that he had lied about his drug use when purchasing a handgun. We understand, according to this court filing, that he has agreed to probation for filing his taxes late. Of course, this deal still has to be approved by the federal judge, and Hunter Biden is expected to appear at a federal court in Delaware in the coming days to enter this plea. But obviously, Lisa, this could have major implications for the re-election campaign of his father, President Joe Biden, who is currently out in California campaigning and fundraising as we speak. And on the 2024 note as well, we have to talk about the other likely frontrunner in that race, former President Donald Trump, having separate legal news of his own today. A week after his arraignment on federal charges, 37 counts related to his handling of classified documents at his Mar-a-Lago resort in Florida after leaving the White House, a trial date has now been set by a Trump-appointed judge. Judge Aileen Cannon has set that trial date for August 14th of this year, less than 2 months from now. Now, that is not set in stone. The Trump defense team could still push to delay that via different filings. But of course, the judge here is setting a pretty speedy trial date after the special counsel Jack Smith had asked for one when this indictment came down less than 2 weeks ago. And should it actually be in August, we have to keep in mind that could mean this trial is ongoing during the first presidential primary debate for the Republicans on August 23rd in Milwaukee. And we also have long expected that another potential indictment from the district attorney in Fulton County, Georgia, could also come down in August. So this morning, Lisa, legal woes mounting for former President Trump and for the current president's son as well.
Kayleigh, thank you so much. In the meantime, on the international relations front, that have dovetailed into Tony Blinken, Secretary of the U.S., heading over to China. Olaf Scholz is hosting one of the key officials of the Chinese Premier, Li Qiang, and joining us now to really talk about what the ramifications and the intel is. Oliver Crook joining us now from Berlin. Ollie, what are we learning?
That's right, Lisa. So this meeting was always going to be about signals rather than substance. We're not really in a stage where we're going to get big signed agreements, going to get big, rollouts with this relationship. But basically, it is significant. And the Chinese Foreign Ministry wants us to read into the fact that for this premier's first trip abroad, he has chosen Germany as the first location. These are Merkel-era level talks that were between the German government and the Chinese government. But this is not the Merkel era, and this is the backdrop of these conversations where Olaf Scholz and the government are talking about de-risk, 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 but wait, don't decouple. So there's also no full China strategy from the Scholz government yet. That is expected to come out at the beginning of July. And let's not forget the economic imperative here. The trade relationship between Germany and China is 300 billion euros. It's the biggest relationship for Germany. And for many of these companies, BASF, BMW, Siemens, they are still investing in China. So it's a lot of cake having and eating going on here. I was just at the German industry lobby event where I spoke to the CATL Europe CEO, and I spoke to another German CEO, and I said, hey, can we do an interview? He said, what do you want to talk about? Relationship with China? Maybe not. It's a little bit too sensitive right now.
Oliver Crook, it is not just in Germany, it is also in the U.S. Thank you so much for taking the time, and we'll be looking for more of your updates. Coming up, the market-moving events that you need to be watching. That's next in our trading diary, about 25 minutes into the trading session, just a bit lower. This is Bloomberg.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
This is Bloomberg.
This is Bloomberg The Open. We're about, 25 minutes into the trading day. What you could see is softness, 0.4% decline sticking in the S&P, although the NASDAQ has retraced a lot of those losses as the session has gone on. In the bond world, you have seen kind of a split field here with people looking for potentially more rate hikes, and yet all of the major benchmark issuances all lower on the day. You can see 2-year, 10-year, and 30-year all lower, led by the 30-year. Time now for the trading diary you need to be watching this week. FedEx earnings coming after the bell today. Fed Chair Jay Powell testifying before the House Financial Services Committee tomorrow. On Thursday, the Bank of England announces its rates decision, plus Powell testifies before the Senate. We'll also get U.S. existing home sales following today's incredibly hot data when it comes to some of the housing market starts. Then we round out the week with Fed speak from Mester and Bostic after what we have heard today from Jim Bullard. This was Countdown to the Open from New York. This is Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Paul Sweeney, Jess Metten joining you here for the next 3 hours. Coming up, we're going to check in with Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, get his thoughts on what we can expect from this Federal Reserve going forward. And then it is a Tuesday, kind of a merger Tuesday, if you will, since we were off yesterday. And what does that mean? Another deal in the pharmaceutical space. Sam Fazeli, he covers all the pharma stuff for Bloomberg Intelligence. He'll join us. So we got a lot coming up. But first, we want to just check in and get the latest on some of the news coming out of D.C. We'll get to that in just a moment. But first, we're going to go to Nathan Hager and get a Bloomberg Business Flash.
Yeah, we're starting off this holiday shortened trading week, Paul, with equities ticking a little bit lower after the S&P 500 notched a 14-month high last week. We saw housing starts before the open surge last month by the most since 2016. Got a pretty interesting note out from our Markets Live team on the heels of that, saying that the signs of resilience in the housing market now could run up against the Federal Reserve's goal of tamping down the economy. And if that means an extended hawkish tilt from the central bank, it could weigh on risk assets. And add to that the question of whether this market is looking overbought. You can add Dennis Gartman, the former publisher of the Gartman Letter, to the yes camp on that question.
The market has what we commonly said in the last several months, bad breath. The number of stocks that are down for the year is substantially higher than the number of stocks that are up for the year, and only 7 or 10 of the stocks on the S&P 500 have accounted for all of the gain thus far. So yes, the market is egregiously, preposterously, seriously, almost comically overbought and due for correction.
And we check the markets for you all day long here on Bloomberg. The S&P 500 right now is down 21 points, or 0.5%, 4388, just short of the 4,400 level for the S&P 500 right now. The Dow Jones Industrial Average is down 194 points, or 0.6%, 34,103. The NASDAQ is down 43 points, a decline of 0.3%, 13,646. 9 of the 11 major industry groups in the S&P 500 are in the red right now, dragged lowest by energy and real estate on the heels of that housing starts news. The 10-year Treasury is up 9/32 right now, the yield 3.72%. The 2-year yield is at 4.69%. NYMEX crude is down 2.5% now, down $1.77 at $70.01 a barrel. COMEX gold is down 1.5%, or $29.30 at $19.42 even an ounce. The euro trades at 1.0915 against the dollar. The yen is at 141.59. Bitcoin right now is higher by almost 0.4% at about 26,800. You mentioned the merger Monday observed. Well, we are watching shares of Dice Therapeutics right now. They are higher by nearly 38%, with Eli Lilly buying the company for about $2.4 billion. It's a San Francisco-based biotech that's developing oral treatments for immune diseases. Eli Lilly's paying $48 a share in cash, and right now Dice trades at $46.61 a share. Eli Lilly, by the way, is higher by 1.33%. That's a Bloomberg Business Flash. Bloomberg Markets is on with Paul Sweeney and Jess Menton.
All right, Nathan Hager, thank you so much. We appreciate it. Jess Menton and Paul Sweeney here in the Bloomberg Interactive Broker Studio. Jess, good morning. Welcome.
Happy Tuesday.
Happy
Paul.
Tuesday. Yeah, nice short week here. And today is day one. We're streaming live on YouTube.
How exciting is this?
Exactly,
I love it.
exactly. So that you can see us in addition to hearing us. How fun is that? You can find our channel. Just search Bloomberg Global News on YouTube, and you'll check out our YouTube channel streaming the Bloomberg markets here. A lot of news out of Washington, D.C. today on the legal front. I mean, we started off the day. Looks like President Trump faces an August 2023 trial in the classified documents case, so we've got some clarity there. Then just breaking recently, Hunter Biden to plead guilty to tax charges. So we want to get to the bottom of this news coming out of Washington. Nick Ackerman, former assistant special Watergate prosecutor, joins us. Nick, let's start with the news first on President Trump. If nothing else, he's going to receive a speedy trial, if you will. I mean, this is happening very quickly.
Yeah, no, I mean, Florida, the Southern District of Florida is known for its rocket dockets, and clearly he's on there. And I think it answers a lot of questions that people were concerned about with this particular Judge Cannon, who was a Trump appointee, that somehow she would drag this out and delay it for Trump. That is not going to happen. I think one of the overriding themes that comes out of our news this morning is really the rule of law and how it has been enforced with both of these developments today. One, you've got a Trump appointee as a judge who is moving this case along and bringing it to trial. And two, you've got the Hunter Biden guilty plea that was done and overseen by a former Trump appointee as U.S. Attorney in Delaware, who was purposely kept on in order to deal with this matter. And he had the final, ultimate decision as to how it would be taken care of. The Attorney General kept himself out of it for fear of some kind of a conflict between the fact that he was appointed by President Biden and he would be making the decision. Instead, he delegated it completely to this Trump-appointed U.S. Attorney. And in the same way, the decision to indict Donald Trump on the classified document case was delegated to a special prosecutor that was totally out of the politics and was removed from the Attorney General. So I think today was a good day for the rule of law.
Mm-hmm. So, Nick, has the Biden administration responded to either case yet?
No, and there's no reason for them to. I mean, they should have absolutely nothing to do with either case. It's important that they keep their distance and that the public understands that the decisions being made on this case are being made by totally independent individuals, whether they're the prosecutors or the judges.
So, all right, Nick, let's, I guess, focus on presumably what is the more important case here. What is your expectation? I mean, this is only going to be, they announced a 2-week trial, so that seems very expeditious, if nothing else. How do you expect this to play out?
Oh, I think it's likely to play out just the way she's got it set up. I mean, there may be a little bit of a delay in here, but this is not a difficult case. It's fairly straightforward. The number of classified documents, I think, is somewhere around 30 that are at issue here. There's testimony by witnesses. There's going to be pretrial motions, all of which are, for the most part, as far as I can tell, are pretty frivolous and will take no time to dispose of. So there's no reason why this case can't be put on trial in August. I mean, this judge is spot on. This is the way the case ought to be handled.
Nick, should we expect a plea deal from former President Trump's camp? Is that something that we should expect, or do you think he prefers or he should go to trial?
Well, I think he's a fool to go to trial because the evidence, at least as it's set forth in the indictment, is extraordinarily powerful. And his statements, even his statement last night on Fox News, he keeps digging himself in deeper to this and creating more fodder for the prosecution in the case. The best thing that I would advise any client to do under these circumstances is to somehow get a plea deal. But knowing Donald Trump, I'd say that's pretty unlikely.
How does this affect the election?
Well, that's the whole point. If this case is done by early September, it's not going to affect the election at all. I mean, if he's convicted, good luck to the Republican Party if they want to nominate somebody for president who's convicted for mishandling and obstructing classified documents. I mean, I just don't see that happening here. So I think by doing this on this schedule, this is a good thing in terms of the election.
Nick, thanks so much for joining us. Really appreciate you jumping on with us. Nick Ackerman, former Assistant Special Watergate Prosecutor, giving us his thoughts and analysis on what's been a pretty busy news front this morning from Washington, D.C. on the legal front. Former President Donald Trump getting his court date in August, and the son of President Biden, Hunter Biden, coming to a plea agreement with prosecutors there. So a lot of news. We just want to get that put into perspective. Let's switch gears here, get back to markets here, because obviously the market's going to be focusing once again. We just had the Fed make their announcement last week. We had the ECB and lots of other central banks.
But the man himself going ahead on Capitol Hill on Wednesday and Thursday, Fed Chair Jerome Powell.
Yeah, that's going to be a little dicey, but that'll be interesting to see how that plays out here. But let's bring in Ira Jersey. He does this stuff for a living. Ira Jersey, he's the chief U.S. interest rate strategist for Bloomberg Intelligence, joining us from the Princeton Brain Trust headquarters of Bloomberg Intelligence. Ira Jersey joins us. So, Ira, let's step back here. We've had a couple days to digest, a lot of movement on the part of the central banks here. What are the markets telling us as to where the market believes rates may go in the future?
Yeah, so for policy rates, the market still thinks that most developed market rates are going to go a little bit higher, just about across the board. But even though the dot plot that the Federal Reserve put out last week, the market isn't believing the 2 hikes that are built into that dot plot. So I think that's interesting. And something you didn't mention, which I think is very important, is the fact that even though a lot of developed markets, European markets, Japan, are likely to have somewhat higher interest rates going forward, you still have the Chinese economy is still faltering a bit, and you saw actually overnight last night the PBOC actually reduce interest rates there. So that's kind of working against some of the tightening of monetary and financial conditions that the developed market central banks are going through right now.
What do you expect that we'll hear from Fed Chair Jerome Powell on Capitol Hill? I mean, as you know, we just got off of that meeting and decision last week. So should we really expect to hear anything new, Ira?
I don't think we're going to hear very much new. We'll obviously be listening very closely to his prepared remarks, because that's directly what he can say. Obviously, with the political environment so contentious and there being extreme partisanship in Washington, D.C., it's very likely that you're going to hear a lot of grandstanding, particularly in the House of Representatives, because that tends to be what often happens. And Jay Powell's going to be asked a lot of questions where he's going to say that's not in our realm, that's for you to decide, or that's for the president to decide. I think that a lot of the questioning, particularly when he's before the House, is going to be a little bit more contentious. Some of the interesting things that I think he might flush out are things like potential end games for quantitative tightening, like how small the balance sheet is going to be, where the lowest level of reserves can be that's comfortable for banks. So some of those kinds of questions will be in the details and the weeds and what we'll be listening for.
So, Ira, I'm looking at the 2-year Treasury, the 10-year Treasury. They're still inverted, in case nobody was paying attention. Now it's 97 basis points of inversion. I mean, that's getting close to the recent lows of negative 108 points here. I mean, Lisa Bromwitz tells me I need to pay attention to this stuff, but it's been inverted for a long time.
It has.
I'm not sure what I should make of it.
Yeah, well, traditionally, all the curve inversion means is that the market's thinking that interest rates are going to be lower in the future than they are today, and that's not a huge surprise. I think that even the Federal Reserve admits that they're nearing the end of their interest rate hikes. So you wind up with 2-year yields that are approaching 5%. On the idea that firstly that the Fed's going to hike one more time, and then secondly that they're going to stay there for a while, and that's one reason why you have 2-year rates that are where they are, and meanwhile 10-year rates down at 3.7-ish% are there because the market still thinks that once the Fed cuts, they're going to cut to about 3% and then stay there for a while. So the average of all of those interest rate hikes and interest rate moves by the Federal Reserve just average out to 3.7%. Our job as strategists and investors is try to determine is there risk to that, and I think over time what we're going to see once the Fed does in fact finish their hiking cycle, and it becomes clear that they have, that actually those 2-year yields are going to start to decline pretty rapidly, and we're going to wind up seeing what we call a bull steepening of the yield curve, where 2-year yields come down much faster than longer-term yields.
Ira, I have to get your thoughts on what's happening with money market funds, because you, in a latest story that you did have on the Bloomberg Terminal, you were talking about how you think that money funds will still prefer the Fed reverse repurchase agreement facility. Can you break that down, sort of the background with this and why you think that is?
Yeah, so the Fed's reverse repo facility was a way to basically stop the Fed funds rate from going down significantly with a lot of excess cash being in the financial system. So it allows the money market mutual fund community to access the Fed. And it's become a key part of the asset holdings of those money market funds, where money market mutual funds like the fact that they have daily liquidity, they face the Fed, so there's no chance of default, and at the same time, it meets a lot of the SEC regulations for liquidity purposes. So I do think that the RRP facility is likely to still have a significant amount of assets, even when the Federal Reserve starts to cut interest rates. Even if it might not be the $2 trillion it is today, it might be $1 trillion, but nonetheless, it's become it's going to be a regular feature of money market fund holdings over time. And the risk there is that as the Federal Reserve continues to run off its balance sheet, at some point, the Fed's going to have to basically stop its asset runoff, because there won't be enough bank reserves in order to kind of satiate the financial sector. And we're not there yet, and our current thinking is, in the forecast we put out this morning, is for next February for us to hit that lowest level of comfortable reserves.
All right, enough of this interest rate talk. Let's get to something that's really important. Lionel Messi coming to Major League Soccer in Miami. That seems big to me.
Yeah, well, obviously he's an icon. He's been the best player in the world for well over a decade now. The fact that he's coming to Major League Soccer is going to be a boon for the soccer market. I personally think it might be a little bit of a risk, Paul, in that is this a retirement league? Because Lionel Messi is certainly at the end of his career as to the beginning. But Major League Soccer has shown that that soccer in the United States is growing by leaps and bounds. And the fact that he's willing to come here instead of getting a big payday by going to other leagues, I think is telling about the soccer landscape shifting in the United States. And the World Cup in 2026 is going to be a very big deal for us.
Can we still send, or do we send American players to play in some of these top European leagues?
Absolutely. In fact, we had the final of the Nations League, which are all the national teams in North and Central America, just happened. The U.S. beat Canada 2-0, by the way. And almost all of those players that started for the United States play for teams in Europe, whether it's the first tier or second tier of different European leagues.
All right, good stuff. Yeah, the World Cup in 2026, that'll be huge. So we'll talk to Ira about that.
I'm disappointed he's not wearing the soccer suspenders today.
They go casual down in Princeton. Ira Jersey, thanks so much for joining us. Ira Jersey, he's an interest rate strategist for Bloomberg Intelligence, giving us his thoughts on these markets. And he's a soccer crazed dude.
He is.
And he owns a piece of Real Central New Jersey, which is a minor league soccer team, which I didn't know there was such a thing, but there is, and it's pretty active. So he's all involved in that kind of stuff. So we appreciate getting a couple minutes of his time. S&P, we are down 0.6%. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Good morning, Paul, and good morning, YouTubers watching our simulcast. Let's talk business. Shares of Dice Therapeutics surge more than 37% at the bell following word of a big acquisition. Eli Lilly will pay $2.4 billion for the biotech company that's developing oral treatment for autoimmune diseases. The transaction is expected to close in the third quarter. UBS is facing hundreds of millions of dollars in regulatory fines over Credit Suisse Group's dealings with Archegos Capital. More from Bloomberg's Russell Ward.
This is just one of the many cases that UBS is inheriting following the completion of its takeover of Credit Suisse last week. In the case of Archegos, we know that Credit Suisse has been negotiating with regulators from Switzerland, the US, and the UK over what happened that led to its massive losses, the $5 billion or more losses that it booked a couple of years ago tied to the collapse of Archegos. Credit Suisse has already admitted risk management failures to the Swiss regulator, FINMA.
Thanks, Russell. Shares of UBS currently down more than 1%. Walmart is king of cosmetics for now. Analysts at Morgan Stanley predict Amazon will overtake Walmart as the biggest U.S. beauty retailer by 2025. They project Amazon will control 14.5% of a market that could reach $180 billion in value by that time. And despite tech layoffs and high inflation, the biggest companies paid their workers more for the second straight year. According to an analysis by the Wall Street Journal, most S&P 500 companies said their median worker was paid more in 2022, and about 100 of them said they rose their pay at least 10%. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Coming up to 10:22 on Wall Street, I'm Nathan Hager. We check the markets for you all day long here on Bloomberg. We're watching stocks edge lower as we head into a holiday shortened trading week after the S&P 500 touched a 14-month high last week. Investors caught between fear of missing out and concerns that markets have run too far too fast are contending with overblown valuations and economic headwinds. All 11 major industry groups in the S&P 500 are now in the red, led lower by energy and materials. Overall, the S&P is down 37 points at 4372. The Dow is down 354 points, and the Nasdaq is down 97. The 10-year Treasury is up 13.30 seconds. The yield 3.70%. The 2-year yield 4.67. NYMEX crude is down 2.5%. Now it's $70 even for a barrel of West Texas Intermediate. COMEX gold is down 1.4% at $1942.40 an ounce. The euro is at 1.0908 against the dollar. The yen is at 141.66. Watching shares of Nike this morning, they are down 3.3%. Morgan Stanley says inventory problems could weigh on margins in the fourth quarter, even as the bank predicts the sportswear brand will have mostly in-line results. And we're watching shares of PayPal as well. They are higher by 1.6% after KKR agreed to purchase up to $44 billion of the payment giant's buy now, pay later loans. That deal frees up PayPal to do more share buybacks. That's a Bloomberg Business Flash. Bloomberg Markets continues now with Paul Sweeney and Jess Menton.
All right, Nathan Hager, thank you so much. We appreciate that. You know, Jess Menton, Paul Sweeney here in the Bloomberg Interactive Broker Studio. We are streaming live on YouTube starting today. You can go check that out. Jess, you know, I've said it before, I'll say it again. You know, my next life, I want to come back as a healthcare M&A banker because there's just deals left and right. We've got another one today, Lilly. to pay
Some big moves here.
Yeah, $2.4 billion for immune drug developer Dice. Breaking it down for us is our good friend Sam Vazzelli. He's head of European research. He's also got a side hustle where he's reportedly a pharmaceuticals analyst for Bloomberg Intelligence. So we'll check in with Sam. Sam, thanks so much for joining us here. Again, another deal here for Lilly. You know, your big pharma companies, I know they do a lot of R&D, Sam, but boy, they're really active on the M&A front, buying drugs and therapies. What are they getting here with Dice?
Hey, Paul, just one comment before we go to Dice. I think your life as a media analyst back in the days wasn't that bad, was it?
No, it wasn't. we had a good role there for a while.
Oh, yes. No, so Dice, basically what Lilly is doing here is that it's acquiring a novel therapeutic approach or novel drug development approach to treating dermatological disease. In this particular case, I think the target's going to be psoriasis, which I think a lot of people are familiar with, in which Lilly is already active. So they have a product called Taltz. It's doing really well, and but it's coming off patent in the late 20s, let's say. And it does make sense for them to be backing into it other products. And let's not forget, a lot of pharma company products, 30 to 50% of them originate outside of the pharma company. You can't own every science, every new methodology for developing drugs, which is something that Dice has got a new approach to doing small molecule pill type drugs. So that's what I think we're seeing and we continue to see.
Sam, how are investors reacting to this? Because if you look at shares of Dice, that's ticker symbol DICE, up about 38% on pace for its best day since October of last year. Looking at Eli Lilly, ticker symbol LLY, up about 1%.
Yeah, well, so, I mean, usually the acquirer, when they're doing such a small deal, let's not forget, Eli Lilly now, at least last time I checked, was the largest pharma company in the world. They overtook Johnson & Johnson, although I think they're vying for that position like who's the wealthiest man in the world kind of situation. So really what difference does it make to them? Yes, it changes a little bit the dynamics of potential downside in their immunology franchise, the psoriasis franchise, 7 years down the road. Great planning. But what really is driving the stock today is the excitement around, as we all know, obesity, diabetes, and Alzheimer's disease. So this is not surprising to me, the way the share prices have moved. What is interesting is that the share price, I'm just watching it now on my screen here, for Dice, this company presented data for this drug way back it's like 9 months ago, October last year. And it's interesting that it's taken this long for them to be taken out. And I have to also say, it's not the biggest premium I've seen with recent deals. So Merck bought Prometheus for around a 70-75% premium, and the Chinook was acquired, or at least announced to be acquired by Novartis just a few days ago, last week, for a 66% premium or 60-odd% premium, depending on where you start. So this 38% premium is not the biggest we've seen, and it does make me wonder why it took so long for somebody like Lilly to actually close the deal, and perhaps they could have paid less. Who knows?
Hey, Sam, talk to us about kind of that risk for patent expirations. I mean, I know you guys as analysts and investors, you probably follow that closely. Do you have a pretty good certainty when drugs come off patent and then when that revenue may be at risk? And are certain companies more vulnerable to that risk than others?
Yeah, I think, Paul, it happens that sometimes some companies go through a wave of them, and then others are pretty immune for a while to go yet. And I think Lilly is one of those that's relatively immune. Pfizer, I think, has more exposure than others currently. But then, of course, they come and go, and then they move on to a new base. And with patents, yes, it's relatively easy because you can get fantastic patent analysts like our own Odd Gerspacher, who digs deep on these things to try and guesstimate when the patent expiry would come. What has muddied the water here, of course, is the Inflation Reduction Act, which is saying that some of your drugs, especially these small molecules, these pills that I've been talking about, will be negotiated in terms of price to get them into a world that looks like as if they're becoming generic in terms of pricing, way before the patent expires. And so that creates an extra layer of uncertainty, which is why I'm actually quite interested in this deal today, because it is a small molecule deal, it is a pill, and it does fall into the IRA trap.
Sam, with healthcare deals on a tear this year, is this a sign of optimism in the M&A market?
Yeah, it's interesting, isn't it? If you think back to last year, interest rates pretty much close to zero. Here and there was a deal. Now, these are not big numbers. $3 billion, what's that to a $400 billion company? But it's make me kind of chuckle a little bit when interest rates are shooting up, where you would think that M&A would be less likely. These companies are stepping in and doing the deals, which of course is telling you that they don't need any debt to do this. I mean, Lilly has very clearly said we're just going to finance this through our massive cash flow. So what is happening though is that I think they're coming to a point of thinking more and more valuations are where they are. They haven't moved very much. They've taken their time and they're finding the assets that they feel are the right quality for their pipelines.
Hey, Sam, as analysts and investors in these pharma companies, does the market care whether, the Lillies of the world, the Mercks of the world, whether they develop their therapeutics and drugs internally via R&D or they go out and buy it? Do you guys even care?
No, not really. At the end of the day, I mean, obviously, if the R&D engine of the company, they were spending $10 billion a year and they were getting nothing out of it, that's not a good thing. But let's not forget, this product isn't done yet. It still needs to go through what a lot of people don't think about or contemplate, is that it's not just about discovering a molecule. It's about then manufacturing it. Make sure you've got the right manufacturing footprint. Make sure you've got the right package to go to the FDA, et cetera, et cetera. So there's a lot of R&D that still needs to go in here that Lilly will be spending on this product. But nobody really cares as long as internal R&D, which is where the Mounjaro drug, tirzepatide, has come from, which is where their Alzheimer's drugs have come from, are delivering something.
Any chatter of other companies that Eli Lilly might be potentially in the sort of looking here to see potential buying as far as what could potentially obviously continue this behemoth of a company that we've been seeing?
Yeah, so I think the best way to figure that out is to look at the products that are facing competition in the longer term and look at what else is available in the biotech sector. So, a lot of these deals are not coming into the mid-stage development companies. There was a time where everybody wanted big revenue generators to basically do a little bit of financial engineering on that. But what we're seeing more, the names I read off to you, Chinook, Prometheus, this company DICE, these are more mid-stage pipeline fillers, which are therefore going to be tied to what the company is either developing a new therapeutic franchise or it's got a drug like Taltz in the case of Lilly that's going off patent. What you should really be looking for is to marry that with good data that comes out of the companies as they report them.
Hey, Sam, thanks so much for joining us. Really appreciate it. As always, Sam Fazeli, he's head of European research. He's also the senior pharmaceuticals analyst, one of the top analysts in the city of London. He's been covering the pharma space and the biotech space for a long time. So we appreciate getting some of his time. He was indispensable. You think back to the dark days of the pandemic, we needed to speak to smart people like a Sam Fazeli to figure out what's going on and where's the vaccines, where are they coming from, all that kind of stuff. So we appreciate getting that. Looking at the markets here, S&P 500 trading off 0.9%. So a little bit of some weight to the tape here today, Jess.
There definitely is. And when you're looking kind of more broadly, right now, all 11 sectors in the S&P 500 are lower, led by losses in energy and materials, followed by financials. If you look at more of those defensive type corners of the market, like staples, utilities, those are more geared toward flat right now.
Yep, absolutely. Looking at the yield curve here, again, a little bit of a pullback in yields. 10-year Treasury off about 4.5 basis points, 3.71% on your 10-year, 2-year off about 3 or 4 basis points, 4.67%. Right now, let's head down to Washington, D.C. We get World and National News with Amy Mars.
All right, thank you, Paul. The Justice Department has charged President Biden's son, Hunter, with federal tax and weapons offenses. Hunter Biden has agreed to plead guilty to 2 misdemeanor charges of failing to pay his taxes on time and avoid prosecution on a separate gun charge. The agreement must still be approved by a federal judge. He is expected to appear in federal court in Delaware in the coming days to be arraigned. The Coast Guard is racing against time to find a missing vessel used to explore the Titanic. Rear Admiral John Mauger says the Coast Guard is using search resources both in the air and in the water in an area about 900 miles east of Cape Cod, Massachusetts. The submersible is designed to have enough oxygen for its passengers to survive for 96 hours. Both sides say the trip was successful, but China's foreign ministry is describing President Xi's meeting with Secretary of State Antony Blinken as a courtesy. We get more from Bloomberg's Stephen Engel in Hong Kong.
The meeting that Xi Jinping gave to Blinken is a good sign. He didn't have to do it, and he wouldn't have done it on Chinese soil if the tone was bad.
Still, Bloomberg's Stephen Engel reports both sides agreed to keep talking. Chinese Foreign Minister Qin Gang plans to visit Washington in coming months. In a wide-ranging interview with Fox News, former President Donald Trump says he did not return the hundreds of classified documents to the National Archives because he was too busy. Former President Trump telling Fox he's been too busy to remove any of the personal items from those boxes when they were packed at the White House.
Before I send boxes over, I have to take all of my things out. These boxes were interspersed with all sorts of things.
Trump also claimed he did not know that there were classified military plans among those documents, even though there is an audio recording of him talking about it and how he could not declassify the documents anymore. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris. Much more still to come on Bloomberg Markets. You're listening to Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:40 on Wall Street. I'm Nathan Hager, watching stocks slide this morning. Treasuries are advancing and the dollar is strengthening. Investors caught between fear of missing out and concerns markets have run too far too fast are contending with overblown valuations and some economic headwinds. Strategists at Citigroup say bullish positioning has grown to its most extended levels for the S&P 500 and the NASDAQ in data going back more than a decade. Matthew Miskin is co-chief investment strategist at John Hancock Investment Management. He says this may be the time for investors to give this rally a rest.
Right now, the time to fix a roof is when the sun is shining. When we look at portfolios that have been overweight risk, that have actually done well this year, you've had to have real risk on to do well and outperform this year. We would look to trim into some of this strength and redeploy into higher quality fixed income, take some chips off after such an exceptional run.
And we check the markets for you all day long here on Bloomberg. The S&P right now is down 36 points, or 0.8%. The Dow Jones Industrial Average is down 341 points. That's a drop of 1%. And the NASDAQ is lower by 0.75%, down 104 points. All 11 major industry groups in the S&P 500 are in the red right now, dragged lowest by energy and materials. Biggest downside mover in the S&P right now is SolarEdge. Those shares are down 7.8%. The 10-year Treasury is up 12/30 seconds for a yield of 3.71%. The yield on the 2-year is 4.67. NYMEX crude is down 2.8%, now down $2.01, $69.77 a barrel, so just below the 70 handle. COMEX gold is down 1.3%, down $26.10 at $19.4520 an ounce. The euro weaker against the dollar at 1.0902. The yen is at 141.58. Rivian shares are higher by 2.5%. It's the latest automaker to hop onto Tesla's charging standard. The electric truck maker says customers will be able to access 12,000 Tesla superchargers with adapters as early as this spring, and a Tesla-style charging port will come standard with Rivians starting in 2025. And Tesla shares, by the way, are higher by 1.3%. That's a Bloomberg Business Flash. Bloomberg Markets continues. Paul Sweeney and Jess Minton.
Thank you, Nathan. We appreciate it. Jess Minton, Paul Sweeney here in the Interactive Brokers studio. And we're going to change things up with a C-suite conversation with someone who I hear actually went to a school in Texas
Yes.
as well. So I'm excited. Matt Rowe, Chief Revenue Officer at the auto lending enablement firm Open Lending. He's going to chat with us about the auto market, car loans, credit crunch, all things about that. Matt, thanks so much for joining us.
Yeah, thank you guys. Thanks, Paul and Jess.
I have to get your thoughts when it comes to the auto space and with the backdrop, obviously, with the Federal Reserve and the direction of the economy. Are you noticing any sort of red flags pop up so far when it comes to auto lending?
You know, not at this time. I mean, I think everybody is curious and watching. You know, we've seen used car values over the last couple of years, you know, induced by the pandemic and the shortage of supply of vehicles, drive car values to the highest we've ever seen. And we've seen the biggest drop last year in the Manheim Index on record. So I think, you know, cautiously watching what used car values are doing, and then the ever looming, you know, recession that we may or may not be in, has lenders thinking about, you know, from a strategy standpoint, you know, how can they still drive some growth, but not, you know, avoid some of the risk that may be out there today.
Hey, Matt, we may be in a recession or coming into a recession. People have been talking about it for more than a year. What are you seeing in terms of the credit quality of your portfolio? Are your borrowers, are they struggling?
You know, so we tend to focus more on the near prime consumer. And what we have typically seen, even through the Great Recession, is that near prime consumers can weather, you know, economic storms better than prime consumers. And so, you know, from a risk standpoint, we encourage, you know, banks and any auto lender to diversify their portfolio, because, you know, again, typically, you know, what we saw in the Great Recession was that prime consumers defaulted at a much higher anticipated rate than the near prime consumers. So, you know, we have not seen anything out of the norm as of yet as it relates to higher than expected delinquency at this point in time. But, it's something that we continue to monitor.
Matt, do you guys lend directly to borrowers, or do you provide financing for the dealerships? How does your business model work?
Yeah, so we actually are a lending enablement platform solution that allows auto lenders to better assess risk at origination. So we work directly with the banks, credit unions, any auto lender on their near prime auto lending strategy to help them price and assess risk better at the time of origination of that auto loan.
Something that struck me is the car shopping website Edmunds was talking about how the $1,000 auto loan payment is actually becoming more common, and about 17% of people who bought new cars in the first 3 months of the year have an auto loan payment of about $1,000 or more. How is that possible? And how is that even sustainable?
Yeah, it is pretty wild. I mean, I think, obviously a lot of that was driven by the shortage of car vehicles out there, right? So, I mean, when the pandemic, caused the auto manufacturers to stop making new cars, the cars that were available, the price of those just obviously went up. So, coupled that with, rising interest rates over the last year, it's just exacerbated some of the affordability issues that the consumers are having out there today. So from a bank and a credit union standpoint, we advise them to take ways to although payments have gone up, how can they protect themselves from a risk standpoint of that increased payment? But a lot of times, from a near prime consumer, payment is everything. And so as long as they're assessing the collateral value and that residual value appropriately on the front end, it puts the bank and the credit union in a better position to withstand some of these things that we are seeing, as it relates to affordability and the economy.
Hey, Matt, I seem to remember in the news in the last several weeks, a bank or multiple banks just kind of pulling back from the auto lending business. What are you seeing in the marketplace in terms of the number of lenders actually out there providing credit to this segment of the economy?
I think today, I think what most banks and credit unions are trying to do from an asset liability management perspective is focus on shorter duration loans. Obviously, given what's happened with, Silicon Valley Bank's collapse, they need to focus on lending to those consumers that, have a greater value. So are they achieving a return that exceeds their cost of capital because of what's happened with interest rates? Obviously, everybody's cost of capital has gone up. And so, maintaining balance sheets is what's the most important things, and pricing those loans correctly. And that really ties back to using correct data and to be able to predict loan performance ahead of time, and ensuring that they're, again, hitting those yield targets that they need to hit today, right?
What indicator are you watching to see if more Americans are falling behind on their car loans?
Yeah, so we obviously monitor 60-day delinquencies very closely. I mean, that is sort of the standard for any auto lender out there today in terms of monitoring risk. And, is that's kind of the leading indicator for, what is my defaults, or is this borrower's ability actually going to make their next payment? And so I think that's obviously one that most of the industry watches just as a sort of the leading indicator for future losses.
Hey, Matt, just about 30 seconds here. Just overall, I mean, it looks like Detroit settled on this annual manufacturing figure of maybe 15 million vehicles per year versus maybe the 17 or 17 million plus before. Do you think that's a new normal?
I think that it's getting back to where I do think the 17 million a year is where we're going to get back to. I mean, the auto manufacturers, need to make cars, and so they're going to do that. And I think what we're seeing on the incentive side is that those incentives are coming back, and so that will drive new car prices down as we've started to see that. I think we just saw the first time in a couple of years that the average car sale for a new vehicle was below MSRP. So I do think we're going to get back to normal levels, pre-pandemic levels.
All right, Matt, thanks so much for joining us. Really appreciate getting some of your thoughts there. Matt Rowe, he's the Chief Revenue Officer for Open Lending. Open Lending provides lending solutions for auto dealers. So really focusing in on that auto business. And that's one of the areas that economists say they really focus on to see some cracks in the consumer. So we'll continue to pay attention there. This is Bloomberg. All right, let's get some company news right now with Steve Rappaport.
Paul, another automaker, makes a deal with Tesla for access to the company's network of EV chargers. Bloomberg's Ed Ludlow reports.
Rivian signing an agreement with Tesla that would see them adopt the North American Charging Standard, or NACS standard, in production models of their current generation R1 T01S and then future generations of the R2 from 2025. In the interim, Rivian drivers will have to use an adapter, but they will have access to the Tesla supercharger network in North America, around 12,000 superchargers.
Thanks, Ed. Rivian stock is currently up more than 2%. Shares of Dice Therapeutics soar after Eli Lilly agreed to acquire the company for about $2.4 billion. More from Bloomberg's Jeff Bellinger.
Steve, Eli Lilly agreed to pay $48 per share in cash for the biotech company that is developing oral treatment for immune diseases. That amount is a 42% premium above Dice's closing share price on Friday. The transaction is expected to close in the third quarter. Big drug makers have been shopping for biotechnology firms with immune therapies that can fill a variety of patient needs and conditions such as psoriasis. Oral drugs are often preferred to injectables, which can be expensive to make and store and sometimes require complex administration. Steve?